The intervention timetable will also be given. So start you the one panel. Then go into the panel account, you do the cash flow, and we are done. For example, the intervention, maybe one or two standards also be added. Then we try to solve one or two questions, and we will be done. So we are going to do IFRS 15. That is revenue from contracts with customers. Revenue from contracts with customers. And using AP. It's mostly the red is okay. How long will the red last? Okay, please. We always say that it's you who are supposed to learn. Actually, we have facilitated the standards, and I guess you are going to write the exam, so you have to have time to learn. Actually, if you don't have time to learn, it means that you cannot get it back. You cannot get it. So as we have always been doing, have time, please. If it is 1 week for the revision, get it and do it. Because the exam is not easy as such. But with your preparation, you can go through. You can go through. So we have done a lot of standard. We have also done the consolidated financial statement, right? And we have done the ratios. We have done ethics. For the framework, you have to read. It's more of the reading. So go and learn what an asset is, what a liability is, what an equity is, then the characteristics of the accounting information. Those concepts, go and learn it. How the standards are formed or promulgated, you have to learn it. They can come in the exams for financial reporting, can be there. As for corporate reporting, it's only the ethics in that manner you can. But yours, ethics can be 5, and that framework can also be 5. You have to know what to write when you get there. We say that it's not good to start with the consolidated account because sometimes, but if possible, you do the ethics or first to relax the body in the exams hall. You do the ratios to relax the body, write your report. As at that time, you may be getting about 23, 25 marks. Then you can go and do the final account that we do today. You can also get more than half. Then you do some of the standard that you are familiar with. Then the last one, you go and do the consolidation. If you open it, you open all of that as we taught you. You find your consolidation in the group structure, open the consolidation there. Even if they say stop, it means that you pass. Please, you have to pass before you get to the exams hall. It's not in the exams hall that you are going to pass. There you cannot be thinking. You have to write what you know that you have learned. If you are going to waste the time thinking, it means that you won't finish. And you will not get the marks that you need to get. You have to always be busy in the exams hall and get through with it. For FR, majority of those who wrote, I don't think they came back. Unless maybe you do not have time to prepare or you do not write. A lot of students who wrote last sitting, they did not come back. I can only see a few, I don't know. Sometimes when you ask them, they will say, I will not register to do it. So FR is not that difficult for you to waste so much time in there. So get prepared. Pass before you, because when you get a question, you have to know where to start. It's not like you are going to read to know what are supposed to start. And as we are saying, go and do the ethics and framework first. So you know the question number that comes with it. When you are going to do the intervention, you are going to be mentioning them. Then you go and do the ratio, you go and do the final account, you do some of the ethics. So that you don't waste time. You don't waste time because you have to know what you're doing before you enter the answer. Okay. Let's do the IFRS 15. Afterwards, we come and do the final account. We break and then we come and do the cash flow. And you are done for the day. So that is how you are going to do. You are going to close around 5. 5. Okay. Revenue from contracts with customers. Revenue from contracts with customers. Revenue from contracts with customers. All that the standard wants us to do is to be able to recognize the necessary revenue in our income statement. We have to be able to recognize the revenue in the income statement. As you did the consolidated, you saw that there's a revenue figure there. So that revenue, how are you going to recognize the revenue that is in line with the standard? And that is what we are going to do. So let's first identify how the contract is. Because you are saying that revenue from contract with customers. So what is a contract in here? The normal contract at the level 1 is what we are talking about. Business or contract. So when you are saying contract, it's an agreement between 2 or more people or party, 2 or more party or people. However, there's supposed to be intention to create legal relations. Agreement between 2 or more parties, and they intend to create legal relations. They intend to create legal relations. One of the pillars in contracts as a law is that there's supposed to be that legal relation content. But sometimes we may agree as friends, there's no intention to create legal relation. So it means that you cannot take me to court. But if there is intention to create legal relation, then I can pursue the case at the law court. So it's supposed to be. Then who is the customer? It's also very important. So who is the customer too? The customer. These are the clients of the business. The customer is the client of the business. The client of the business. Or those who patronize the product that the business produces or the entity produces. Those who patronize the product or the activity or the service that the entity undertakes. Then the last one is the revenue. Revenue from contract with customers. So all the terms in it. What is the revenue? As in here. And we are saying that revenue is the income generated. The income generated from ordinary business operation. The income generated from the ordinary business operation of the entity. The revenue is the income generated from the ordinary business operation of the entity. Ordinary business operation of the entity. So that is the income that is generated from the core operation of the business. So whichever, if it is an institution like ours, then the revenue is supposed to be the teaching fees and the registration fee. Any other money that comes in is not revenue. So you have to be able to distinguish between the revenue and any other income. But when you are talking about the revenue, what the business is set out to produce or to sell, the income that they earn from there is what we mean by the revenue. So if it is a GRA, it means that your whole activity is for tax, the tax revenue. So all the tax that you are earning is going to be the revenue, or you're taking is going to be the revenue. Then since you have brought in the income, let's try to bring in the definition of the income in the definition of the revenue. The income is the increase in economic benefit. The income is the increase in economic benefits. Increase in economic benefit or a result of increase in assets. Increase in economic benefits as a result of increase in assets or as a result of increase in assets. Increase in economic benefit as a result of increase in assets or decrease in liabilities. Or decrease in liabilities. Increase in an asset or decrease in liabilities, which is not as a result which is not as a result of contribution, which is not as a result of contribution from ordinary, which is not as a result of contribution from ordinary participants of the business. Increase in economic benefits as a result of increase in asset or increase in liability, which is not as a result of contribution from ordinary participants. So when we are saying income, the revenue is a subset of the income, right? The revenue is a subset of an income. But income is general. Anytime that you have increase in economic benefit, that means that you have an income. And it could be as a result of appreciation or increase in the asset. So if our cash increases, it means that the difference between the old and the new means that we have an income. If any PP, as you did the PP, revaluation in the PP will be an income. And it is going to be an income. So we may say that there's a revaluation surplus, and it will be in the other comprehensive income as such. It's also an income. And if there is also a reduction in a liability, so supposing that we are only 50,000 and the person says that we are supposed to pay 45, that reduction means that it's an income to us. So we are saying that all these incomes are supposed not to be as a contribution from the shareholders or the owners of the business. So as we increase in our cash, that cash is supposed not to be a contribution from the shareholders or the owner of the business. If it is as a result of that means that it's not an income. It's going to be a capital kind. Okay. So that is what it means. And the standard requires that you take or the processes in recognizing the revenue. There are 5 steps. There are 5 steps that you have to take in order to recognize the revenue in the financial statement. The recognition is what is important. So let's go through the 5 steps. And anytime you have any transaction or activity, then you have to pass through that 5 steps to recognize the revenue. Then the first step, the first step is to identify contract with customers. Identify contract with customers. That is the first step. Identify contract with customers. Contract with customers. So as you said, the whole thing is contract revenue from contract with customers. So you are supposed to know that the issue is a contract between the entity and its customer. If it's not a contract, then it will not meet the standard. So identify the contract with the customer. So you have to know that I have agreed to sell goods to you, and you have also agreed to pay me. So if that is the case, then there is a contract between us. So as you fill the form to come and do 1 or 2 or 3 subjects, that is a contract. That is a contract. So we are supposed to identify the contract. So far as you are here, we have signed contracts between ourselves. Okay. Then the second one is identify the performance obligation. Identify the performance obligation. So that is the second step. Identify the performance obligation within the contract. The performance obligation within the contract. The performance obligation within the contract. Identify the performance obligation within the contract. So in that, what we have promised to do, is the performance obligation in the contract. So you said that you are coming for tuition, and we have also promised to give you the tuition. At times, within the tuition to the intervention is also in. So if we are saying that the tuition is what we are supposed to do, and intervention, these are the 2 performance obligations on our side that you have to perform in order to earn that money that you are supposed to pay. So within any revenue recognition, after the contract, then you have to identify the performance obligation within the contract. Then the third step is to determine the contract price. 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 So with the contract price, we are talking about a consideration that is going to come from the customer. what is the contract price? How much are we going to charge you? And that is the contract price. So after the contract, the obligation, then how much you are supposed to pay. You are supposed to know it before you recognize the revenue. Then the next one, the fourth one, is to allocate. The fourth step, allocation of the contract price. Allocation of the contract price. Allocation of the contract price to the performance obligation. Allocation of the contract price to the performance obligation. Allocation of the contract price to the performance obligation based on standalone prices. Based on standalone prices. Based on standalone prices. Okay. So at that stage, you are supposed to be able to share the consideration or the contract price against the performance obligation. So if we have agreed that the tuition, one paper is how much? 400. One paper. 400. 400. Then intervention, nobody? Christian. Okay. It may be 200. Now when you are coming for intervention, you pay 200. If that is the case, that is the contract price. So in all, it's supposed to be 600. Right? But for you as a student, it may be that as you pay the 400, you are not paying anything. You are not paying anything. Apart from the 400 for the teaching. Or let's say that there was registration. So if there was registration, registration is normally 100 cedis, right? So the total that you are supposed to pay as a student is going to be the 500. You are not going to pay for the intervention. Okay. But if you are giving it to you at a standalone price, it means that you do the registration, you pay the tuition, and you pay for the intervention, which is going to be 600. Right? But if you are saying that the contract price or the consideration that you are supposed to pay is only 500, that means that the next step is telling us to allocate the contract price against the obligation, but using the standalone prices. So here you are going to share our portion or allocate whichever one. So the total here is 600. So 600, 100 over 600 times the amount that you are paying will let us know how much of the payment goes into registration. Are you following? Are you sure? So if you are paying for each of them at any point in time, you pay for the registration, you pay for the tuition, and you pay for the intervention. And that will make up to 600. Sorry. Then it's supposed to be 700. So the total is 700. But so far as you register to be a student, you'll be paying only 500. We are charging you 500. But anyone who wants to come and join you in the intervention will pay 200 to join. The person is not a student, maybe you want to enjoy the intervention. So you'll be paying the 200. And within the steps, the standard is saying that you have to identify the contract, which you have identified. Then the performance obligation, which is the registration, the tuition, and the intervention that you have to do for you. So in all, that is what you have to do. Then you have to also know the consideration. How much are you paying? The contract price is 500. Then you have to allocate the 500 against the obligations or the performance obligation using the standalone price. So you have to go back and know the standalone price. And the standalone price is that the registration is 100, the tuition is 400, the intervention is 200. So in all, you are supposed to pay 700. If that is the case, then the next step, which is the step 4, is telling us that allocate the contract price, which is the 500 that we are taking from you, against the performance obligation. And the performance obligations are these, based on the standalone prices. If that is the case, you sum up the standalone prices to make it 700. Then you share the 500 based on the 700 as a standalone price. And in that, we are just going to do proportion. We are just going to do proportion. So if you pick the registration, that means that it's going to be 100 over the total times the amount that we are sharing. So 100 over 700, then the 400 over 700 times 500, then 200 over 700 times 500. So that we know how much of the contract price goes into any of them. So the first one, how much are you getting? 71.43. And the second one? 285.7172, whichever. Okay, the last one? 142.86. No one has it's a real one. So when you sum it up, you are supposed to get 500. You are supposed to get 500. So it means that you have been able to allocate the contract price against the obligation. Then we move on to the last step. I hope there is no question. Is that okay? All right. Then the last step, step 5. Step 5. Recognize revenue. Recognize revenue. Recognize revenue. Recognize revenue. When performance obligation is satisfied. Recognize revenue when performance obligation is satisfied. Recognize revenue when performance obligation is satisfied. Full stop. The revenue is recognized in the income statement. 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 Otherwise, defer. Otherwise, defer the income. Otherwise, defer the income. Otherwise, defer the income. Defer the income. Otherwise, defer the income. Full stop. So the last point is that you have to recognize the revenue. And in recognition of the revenue, as we said, in the income statement, we have the revenue figure. So you just going to add it to the revenue. And you have recognized revenue. If that is the case, that is fine. But if the revenue cannot be recognized, that means that you cannot put it here. That means that you have received a certain income that you work on it later on, or you are going to perform the obligation later on. If that is the case, it is going to be treated as a deferred income. And the deferred income will be in the liability, depending on the time frame, whether it's a long term or short term, then that is going to be a current or non-current. But we are saying that you can only recognize the revenue when you perform the obligation. When you perform the obligation. So giving us here, these are the obligations. So if you are saying that you are using 3 months and we are preparing accounts in 3 months to do all these things for you, then we want to prepare the accounts at the end of, let's say, January. So January, we have done December and we have done January. So we are preparing the accounts. Let's assume that our accounting year ends in January, right? So if you have prepared we are preparing the accounts in January, it means that we have to ensure which of the obligations are we performed. Then we can recognize the revenue. The consideration has been, it may even be that you have paid all the 500. Fine. As for the payment, anytime that we receive the money, we will debit the bank and we are going to credit where we receive the money from. So the person's name will be credited. And if it is that income, you can say that income. Fine. It's not revenue yet. It's not revenue yet, so it's an income. Okay. Then we are doing the accounts to January ending. If you are doing the accounts to January ending, what obligation have we performed now? The first thing is you have to look at the registration. And registration, you have to recognize 71 systems. So the 71.43 is supposed to be recognized when we perform the obligation. So you ask ourselves, as of January, have we registered the student? If that is the case, then we can recognize this one as revenue. I hope it makes sense. All right. Then we have to look at the tuition. The tuition, we are supposed to do it for 3 months. We have done only 2 months. So it means that this tuition, we cannot recognize all because we have not finished performing the obligation. So if you have not finished performing the obligation, then we have to divide this by 3 and recognize only 2 of them because we have finished in the January and we have spent 2 months. So we do the 2/3 of that and recognize as such. It means that the last month cannot be recognized. Then the intervention is 142. As for that, we have not even touched it. So that one cannot be recognized. So it means that if you are preparing the account, our revenue can only be the 171.43 plus that 2/3% or 2/3 ratio of this one. Then the remaining, since we have received, the remaining will go to where? The deferred income. To go to deferred income. And it's going to be a liability. Since we have already recognized the assets there, then that difference will be a liability. So if you have performed it, that means that you can say the 500 will be an asset, the double entry. The 500 will be an asset. The credit side will go to deferred income, and another credit will go to revenue. So the revenue will be this and the other portion. I don't know. You add it, multiply it for me so that I get the exact figure. 190.4. Okay, so add it to this one. Okay, 261.90. So it means that out of the 500 that we have received, we cannot recognize all the 500 as revenue because we have not performed all the obligation to warrant us to earn it. So we can only recognize 261, 0.9, 261.90. I hope it's okay. Then the remaining is going to be, sorry, this one is the revenue, 261.90. Then the remaining is going to be the deferred income. So subtract and get the remaining. 238.1. I hope it makes sense. So that is what the standard says. So anytime that somebody gives you money for a service, check whether within the time, because you are using periodicity at a certain point in time, you have to prepare the account. As at that time that you are preparing the account, have you performed all the obligation? If yes, that means that you can recognize all the revenue. If no, how much of the obligation have you performed? Then assign the revenue or the amount that you have received against that so that you can recognize the revenue. That's what the standard says. The standard does not want you to overestimate the revenue. Because that will amount to creative accounting and it's also accounting. So that is all. We are done. We are just going to solve the other 2 questions. So the first thing is, what is the contract? Identify the contract. The next thing, identify the obligations within the contract. What is the price? So as you identify the obligation, then you just have to find the standalone prices so that when you get to at the allocation, you'll be able to know it. So what is the consideration of the contract price? Then assign the contract price against the obligation using the standalone prices. Get it done. Afterwards, recognize the revenue. So anytime that you perform that obligation, you recognize. You perform, you recognize. You perform, you recognize. If you have not performed, then it's supposed to be a deferred income. It's supposed to be a deferred income. As simple as that. So you solve 1 or 2 questions and it is fine. The question is already on it. Today, we posted it on it. The one with 36, IFRS 5, IFRS 15, IAS 24. I guess everybody is on the platform. Senior.
Some of us, in case you realize that the performance obligations, you won't be able to satisfy all.
That is what you are saying. Intervention, you are not satisfied.
You are hoping that
Yes. Yes. So as for the 3 months, you are preparing the accounts in 2 months. So the one that you cannot satisfy, the amount that is attributable to it is going to be deferred. You have to put it that somebody has given you the money and you are owing the person because you have not satisfied the obligation. So it's a liability to you. The deferred income is a liability, right? You know that. Unima is a liability. So if somebody puts in the money, you have to receive it, and that one will go to bank, definitely. And you have to credit the person. So the person is, because the person has put the money there for you to use to perform the service, it means that it's going to be deferred income. So when you perform the obligation, then you transfer it to the deferred income to the revenue. That is what it's done. So you are going to, if we perform this one, you are going to debit the deferred income and come and put it in the revenue and credit the revenue. Revenue is always credited. So it's basic accounting. Revenue is credited always. So anytime that you receive any receipt, you debit your bank, you credit at first at a lower point, you say 6. You debit bank and credit 6. But at this level, you don't use 6, you use revenue. You use revenue. So if you have not earned that revenue, if it has not turned to sales, it means that you owe the person. The person can come for it, the money at any point in time. So then you put it as a deferred income. So it's like a creditor. But at this level, you don't say a creditor. You say deferred income. So the intervention we have not performed, and part of the tuition too, we have not performed. That is why we cannot recognize all the 500. We can only recognize only 261. The 238 is the intervention plus 1 month of the tuition. Plus 1 month of the tuition. We have not performed that obligation, so we cannot recognize it. Okay. Any other question?
So, sir, some person that we are paid or we are paid in the slave group cannot recognize.
Yes, they have received it, but unless the year lapses, then when they prepare the account, they put it in. Because some people will also pay it as a January. Someone will wait till December and pay it. You cannot afford the person. You are going to use it to write an exam. That's why you have to pay before you write the exam. For us who are not writing the exam, we can wait. Somebody is giving owing 2 years. The person is not writing any exam. So what is the motivation of paying your subscription? But if you are coming to write, then you have to pay before you can even enter into the portal and pay the registration, what do you call it, exams registration. Other than that, it will not allow you to do it. So it's like paying the electricity. If it is prepaid, you have not consumed it and you are paying. So it means that as at that time, the electricity company has not provided you with the light. So unless the month end, then we can recognize it. Other than that, it's a deferred income. It's a deferred income. It's a liability to them. It's like putting your money at the bank, and if you have not come for it, the bank owes you rather. Any other question? Okay. So let's solve the question and try to. If you are not having the person, please let us know to you. IFRS 15. Okay, question 1. Let's start with the question 1 and move on. Okay. That is on page 7, right? Those on the WhatsApp platform. Question 1. Question 1. Anyone to read it for us? Question 1. And I'm in time.
MEMA enters into a 12-month telecom plan with the local mobile operator PLC. The terms of the plan are as follows.
So that is, they enter into, it means that there's a contract. It means that the first one, we have been able to identify that there's a contract. Okay. And continue, please.
MEMA's monthly fixed fee is 100 Ghana cedis.
Okay.
MEMA receives a free handset at the inception of the plan. Asapa PLC sells the same handset for 300 Ghana cedis, and the same monthly prepayment amounts without the handset for 80 Ghana cedis per month.
Okay, so what is the obligations in the contract? The obligation. You have to identify the obligation. What the company is supposed to do for the customer. What the company is supposed to do for the customer. What are the things that the company is supposed to do for the customer?
You see the handsets.
There is the handset. There's a handset that you are supposed to give. And what again? Are you sure? So when you give the handset, that is all. So there is a service also, network service. Service or the network. You have to give them that service or the network. So like the normal Kasapa MTN will give you the phone and also provide the network for you. Without that, when you give me the handset, what am I going to use it for? So that is the obligation. That is the obligation. And if it is a standalone, how much will it be? A standalone. They sell the handset for 300 cedis. You provide the service also as what? 80 cedis per month. Okay, so the 300 cedis. And the contract is for 1 year, right? So 80 cedis times 12. 12 months. That is what it is. At the beginning, they said that they enter into a 12 months. So how much will it be? 960. 960. So standing alone, the handset is going to be 300. The service provision for a year is going to be 960. Do you get it? So in any of the contracts, you have to be able to identify it. Okay, then the transaction price. Transaction price. How much are they supposed to pay? That is the transaction price. So a monthly fixed fee. Have you seen that? Fixed fee. Fixed fee. It's monthly. So each month they are paying how much? 100 cedis per 12 months. And they are supposed to pay 1,000, right? 1,000. Sorry. 1,300 times 12. 1,200. Then, what again? That is all they have to pay. The handset is for free. And the handset is free. But when they are selling it to somebody, if it is not a contract and they are selling it to somebody, you pay 300 for the handset. And you have to also pay for the service 960 for the whole year, or let's say 80 per month. So if it is standalone, that means that the total is going to be 1260. 1260. But as they are giving it to you as a contract, maybe a firm and you want the handset, blah, 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 blah. So they have reduced it in a way. Each month, come and pay 1,000 and that is okay. So in all, it's going to be 1,200 for the whole handset and the service. I hope it's okay. Then we are saying that the next thing is to be able to what? Allocate the contract price, and the contract price is 1,200 against the obligation using the standalone prices. So how do we do it? We are just sharing it against the obligation. So the total as we did is going to be 300 over the 1,260 times the price 1,200. I hope it's simple. Then the second one is 960 over 1,260 times 1,200. As simple as that. So how much are we doing for the handset? 285. Point.
So 286.
Okay, let's make it 286. Then the other one. Pardon? 914. 914. That means that we are also good. So when you add that one, you are supposed to get 1,200. You are supposed to get 1,200. I hope it's simple. Then now you come to the recognition. So you have to get this and get that, assign or allocate, and now you come to the last one to recognize it. So when is the performance done, or if you perform the obligation, then you recognize it. You have to check the date for the account and know when all the obligations were performed. So they enter into that 12 months, the 10 is that, they sell that. So we have to look at the presentation when you are supposed to recognize the revenue. Kasapa PLC sells the same handset at that in the same monthly plan without the handset of 80. How should Kasapa recognize the revenue from of this plan in line with the standard? So the recognition of the revenue. But the question did not give us a specific date to know, right? So maybe you have to use double entry, or you have to write what they are supposed to do. So you are going to say that if you are going to do the double entry, it means that the income the fixed fee of 100, 100, 100, 100 is going to be received each month. That is what it says. Okay. So the income from the handset was given from the insertion, right? It was given at the beginning. So that income is going to be recognized at that point in time when the handset was given. You get it? But the remaining, the service provision, is going to be spread over the 12 months period. So it depends on the number of months. So each month is going to be how much? It means that the 914 divided by 12 will be the amount that's supposed to be recognized each month. Each month. Because that is the total amount. So each month, supposed to recognize this amount, 914 divided by 12. And how much will it be? 76.7. 17. 76. Okay, 17. So you can do the double entry and see that in the income statement, or let's do the double entry. At the time of delivering the handset. At the time of delivering the handset, you have to you can make it one man basis. If you think that you can make it one man basis, that is also okay. At the time of delivering the handset, you have to debit the. Let me check. Where are we doing it? Is it in Casapes or the companies? Because it depends on where you're doing it. So the NEMA enter into a contract with. So the company Casapa is providing the obligation. They are going to receive the income. Okay. If that is the case, then at the debit, we debit the amount which is being received, which is 100 cedis for the month. The 100 cedis for the month. So each month, we have the 100 cedis, and it's going to be at the bank, which is 100 cedis. So that is for the month, the first month. We debit the 100 cedis for the month. You get it? Each month, okay. So he says that, let me go back to the question. The plan is as follows. NEMA monthly fixed fee is 100 cedis. The fixed fee is 100 cedis. So it means that each month we are going to pay the 100 cedis. And we, the company, we are going to receive the 100 cedis. So if we receive the 100 cedis, that means that it's going to be in our bank. Right? It's going to be in our bank. So that's first month. How much are we supposed to recognize as revenue? How much are we supposed to recognize as revenue? And we have seen that the revenue recognition for the service provision is this. 76.17 is what you are supposed to recognize as revenue for each month. Even though the whole year we are going to receive 914, we are not going to receive it at a time. It is spread over the period. So each month, the person is going to pay us this amount.
Why not 76.17?
That is no, the payment is what NEMA is going to do. But you, how much are you going to recognize as revenue? You get it? So NEMA is going to pay 100 cedis. As for 100 cedis, that's what you're going to pay for a month. So when you pay 100 cedis, do you recognize all the 100 cedis for the service, or part for the service and part for the handset? So you have to separate them. So as the service is provided, that means that you have to get your revenue from the service, and that is for the service, and that is 76.17. But from the inception of the whole thing, let me also bring this in. When you get the contract was signed, it means that he is supposed to pay us. He is supposed to pay us that money, the total amount, the 1,200. The 1,200 is supposed to be paid by NEMA for the whole 12 months period. So it means that he is supposed to owe us that amount at the beginning of the whole contract. Okay. So if he is owing us, that means that it's going to be like the receiver. That is 1,200 as in owing us in the asset, or you can see that contract asset, whichever. So that the person owns us that amount. I hope you get it. Alright. Then the credit side is also going to be there as the 12,000 and the 1,200 that he is supposed to pay. So the debit is the receivable, and the whole thing is the income that's supposed to come. The income that's supposed to come. And the income is still 1,200. But for each month, this is what you are going to do. So that when we take the 1,200, he is going to pay it each month. So at the end of each period, we also reduce the 1,200 by 100 cedis. 1,200 baht. It depends on when you are going to prepare the account. But each month, you are taking 100 cedis out of this to reduce it. The whole thing is an income, all right, but his payment, which is going to be in the asset as a receivable, how much he will be paying will reduce the amount that he owes us. You get it? So from the onset, you have to debit the revenue, debit the receivable as the amount that Neyman is supposed to pay. That is the contract price. The contract price. As a contract to be received. So revenue, the receivable as a debtor, kind of.
So that is that we are here to receive.
Yes. So from the onset, as we sign the contract, we are yet to receive the income. So as 1 month lapses, then we receive the 100 cedis. The 1 month lapses, we receive the 100 cedis. And that 100 cedis will also reduce the receivable to 1,100. Then that 100 cedis is supposed to share in between, it will go to revenue, all right. But the revenue, half is for the service and other is for the handset. Because not all the 100 goes to the service provision. Part will go for the handset. You get it?
So it will cost the cost for the service.
It's 80 cedis, but the 80 cedis, when we allocate the obligation, it's not going to be 80 in per month. It's going to be 76.17 per month. So first, what you have to do is that you have to identify the standalone price. Then you have to identify the contract price, allocate the contract price against the standalone price, right? Then, this is what we are supposed to receive. Is that okay? Okay. As this is what you are supposed to receive, then you look at when the obligation is performed. This one will be given from the inception. So you are supposed to recognize all, but the person has not paid all. You get it? So we have the revenue from the beginning, which is 286, and we have the debtor or the receiver, which is 286, because we have given the handset to the person. But the payment plan is different. According to the person, the payment plan is each month he is going to pay 100 cedis. 100 cedis. So even what you have given as a handset, they cannot pay all the handset. You get it? So you cannot take all the 100 cedis from or for the handset. There will still be remaining. And you have also performed the service in addition. You have also performed the service in addition. So even though you can recognize the revenue as such, the money has not been received. So when you receive the money to them, you also take part to the handset and to the service. And that is what you want to do here. So the 100 cedis which is being received, 76.17 will go to the service. And the remaining will pay for the part of the handset. If it is like they have done for 6 months or 1 year, then you can add or you can multiply this by 6 to get the 600. Only pay for part of it that has been done, and the remaining will be there as such. So the explanation is that this one is going to be recognized as revenue from the onset. And that same amount is going to be a receivable. Then the second part, this you have not performed all within the period because this one was given from the inception. So it means that it's revenue. But this one, you have to perform it month by month. So you have to defer the portion that has not been paid. Okay, so let me do it. Let me do it here. And let me do maybe 1 month or 2 months. So the revenue, the debit and the credit. As the receiver, like the first one that we did, the receivable, the person has received this one already from the inception. That is 286. And we, the telecom, we have also perform that obligation since you have delivered an item to them. So that is going to be revenue. 286. I hope it's okay. Or you can say that contract from customers, whether it's revenue or contract from customers. That is okay. Then you go to the service. So this is for the handset. We go for the service. The service, if you are taking only 1 month, it means that you only take 1 month service provision because this handset was given at the beginning of the month. So far as you have given, you have satisfied the obligation, so you can recognize the revenue. I hope it's okay. Then the service provision is supposed to be at the end of the month. Then you can recognize the service provision. So at end of the month, at the end of first month, how much are you supposed to recognize as the revenue? Then we are saying that we can debit, he is supposed to receive that, so receivable. So that figure, the service provision, how much have you provided for that first month? Because this is for 12 months. That is why we divide it by 12 to get for each month 76.17. So at the end of the first month, we have only provided the service that is worth this amount. I hope it's okay. So we debit the receivable 76.17. Then we can credit the revenue 76.17. But the person paid us. The person paid us like another bank 100 cedis. The payment is 100 cedis. We get it. So that 100 cedis that was paid, it means that part is for the service provision and the remaining part will go for the handset. Because we are saying here that he is still owing us. So the debit will be this 286 and that one. Right? So the 100 is supposed to reduce, the remaining 100 is supposed to reduce as we subtract this one, how much will it be?
So we will not make the
Let's look at the page. Oh, okay. So that's supposed to it will be 24. So this 24 will go and reduce the receivable here. This is still standing in the books that the person is owing us 286. Right? It is still standing in the book. He hasn't paid. Here means that he hasn't paid. Even though you have been able to recognize the revenue of 286 because you have performed the obligation. And you have also recognized the revenue of 76 for the service provision. But the payment that the person did was 100 for that month. So the difference will go and pay part of the handset. So that the handset figure in the statement of financial position will reduce. You get it? So that is how it's supposed to be run. So if you are also going to do that, that means that that credit side of the receiver, even though sometimes you see that you don't credit the receiver because of the payment, the person's name needs to be credited. So the receivable here, 24. So by the end of the first month, this one was in the accounts already, and this one will also come. So the amount is going to be 286 plus 76. Then the person paid only 100. So it will reduce the 76 and part of this one. So that there will still be an amount standing in the financial position. So that is the essence.
Indirectly means that for that month he has paid
for the service,
Yes.
or the service for that month, and part of the handset money.
But the handset money is the 286.
Yes.
But if you divide it by 12, you get to
No, since the performance obligation, fine, you get 24. So you'll be paying the first month alone. You will be paying the first month. So it means that he's still owing us 11 months.
yes, that's what I want.
But the recognition supposed to be the whole handset for that month and the service provision for that month. You cannot spread the handset revenue over the period because as at that time, you had already provided the handset. You get it? The timing for the recognition is what the standard wants you to know. Because as you are saying, it will be that, oh, then 24 for handset, 76, no. 286 for the handset because you have performed the obligation.
Sure.
So it's not 24 for the handset aside. The whole 286 is for the handset and only 76 for the service. Because you have not performed the second month service. But in the second month, you are not going to provide another handset. You get it? So you recognize the revenue, but you say that the person is owing. The person has not paid for it. So the person is taking time to pay. So the time for the recognition is what the standard wants you to get. So if it is the first month, the recognition is that you are going to recognize the revenue of 76 as a service and the whole revenue of 286 for the handset. But the payment will be done 100, only 100. So within the 100, only 76 is going for the service and 24 will be going for the handset. It means that still the person is owing you the difference between the 286 and the 24. Is that okay? So if it is an extract of income statement, then income statement extract. You come here and you say revenue. Revenue will be 286 plus 76 for the first month. So if you are doing for only 1 month, it will be 286 plus the 76. If it is 2 months, that means that you multiply the 76 by 2. Not this one, because this one was done at the inception. So it will be what? 262. So that one will be in the income statement. Then in the statement of financial position. In the statement of financial position, the person is owing us. Right? So the asset, that is the receivable. Receivable will have the owing. How much does the person owes us? That means that the 24 remaining here minus this one. I hope you get it. That one will be 262. So that is the receivable figure in the statement of financial position. So how is it going to be treated? It's supposed to be treated this way. Even though the cash and receipt will pass through the same thing, but the remaining amount is what we want. That for the first month. If it is the second month, as you multiply this one, you are also going to reduce this one by 48 until it all gets finished. So the timing for the recognition is what the standard wants you to get. The timing. When do we recognize the those of us who did sale of goods earlier on in our studies? Then they will say that the sale of goods act will tell you that when the goods are delivered to the customer, the person obtained the right. That means that you are free. So if you tell me to even send to somebody and I leave it with the person, it means that you have the possession of the goods. I can recognize my revenue. But the standard is saying that take these steps. Even though you have delivered it and those kind of things, then you have to know when to recognize it. Okay. Any other question? Any question? All right. So you take time. Then the solution is also in there. Just go through it. It's not anything else. difficult. But what you have to do is this recognition, the allocation. Then you know when to recognize. As for the first one, we deliver, so that one must be recognized from the inception. Then you do the account for only 1 month. Please, this one is for only 1 month. If it is 2 months, it's going to change the figure. Yes, yes. So far as the person did not give us the period, if it says that after 6 months, how is it going to be recognized? Fine. You still recognize the first one, then you multiply this by 6, then the receipt is also by 6. So it depends on how the person is going to do it. Okay. Any question? Any question? Let's solve another one and see. I guess that one they will give us the year so that it will not be any issue. Question number 3.
So if you are asked to prepare the financial statement,
Yes, so that is what happened.
the fourth year,
Yes.
and the receivables that means
At the end of the 12 years, it will go. At the end of the 12 years, 12 months, it will go. But normally the question will not tell you to do at the end. It will be somewhere in the middle, so that you can have the balances at the end of the period. If it is at the end, yeah, then you can see.
And the receivable figure has been made for the second month.
Yes. So if it is for the second month, it means that you still subtract the after 24 again. And here it's going to be multiplied by 2. But the timing, sometimes the question is funny. If I say prepare it for the next 2-3 months, that means that you are adding them together, right? But it could be that the first month has been done and come and do the second month. It depends on how the question is framed. If the first month has been done, it means that I have already recognized the 386 and the 76. So the second month's revenue or income statement extra will not cater for this. I don't know whether you are getting me. Because you are using periodicity. I'm doing the accounts each month. If I'm doing the accounts each month, I have already done the first one. So that one, I recognize the 386 there. So the second month, I cannot recognize it again because I have done it already. You get it? But if it is say for the period 6 months, that means that this one will be there and this one will be multiplied by 6. Then I'll add it. So it depends on whether it's separable or not, whether the month has been separated or not. Then we reduce the delta figure or the receivable figure to cater for how much it has been paid. But this one is for the month. You can say that for the month. Let's make it for the month, for the first month, so that it will not be confusing. For the first month, Okay. Let's do question 3.
Edward Limited is a manufacturing and limited company
Okay.
which prepares financial statements in accordance with IFRS after the 1st December each year. In order to generate or improve sales on one of its older products,
We are doing question 3.
the promotion being something for free. The promotion included free maintenance services for the first 2 years. On 1st October 2019, under the promotional offer, the gas sold goes to a supermarket chain for 4.4 million Ghana cedis. A 2-year maintenance contract would normally be sold for 0.5 million Ghana cedis. And the list price of the product would normally be 5 million Ghana cedis.
Okay.
The transaction has been included in revenue at 4.4 million Ghana cedis. Why? In accordance with IFRS 15, revenue from contracts and customers, justify the appropriate accounting for the above transaction in the financial statements of the grant for the year ended December 31st, 2019.
Okay. So with this one too, you have to identify the obligations. So what are the obligations in there? Obligations. What should a juror do? A juror should do what and what? Supply of goods and what?
Maintenance.
So the goods supply and the maintenance. That is the performance obligation. Always you have to be able to identify them. Okay. So yes.
So we can identify the obligation. We need to add it to the solution.
And how are you going to calculate it? No, how are you going to calculate it?
After like you can identify the obligation.
Your head like
Or you have to write it.
I don't get your question. So if you identify it in your head, how are you going to do the calculation?
Oh, you know that.
You do the calculation also in your head. So write what you are doing. That is what we want you to write.
I just wanted to know that their marks are related to like all these.
Oh, it's part of the whole calculation. So if you identify that it's use and maintenance, what are you going to do? So you write it somewhere and you start calculating. Other than that, you calculate it in your head and maybe you mark it in your head. Or you send your head with the exam paper. So please, you have to, anything that comes in there, for me, please, when you go and you need a standard, you don't understand and you have an overview, write it. Because if you are going to say that it's in my head and all that, even this one, if you don't understand it, you can write the steps and you go.
Yeah.
At least the examiner will see that you are serious. Just that you don't have time to do it. But if you are saying that you just remember the whole thing in your head and you go, fine.
Because the standard price.
Yes, you don't understand what you're doing, but you have seen that revenue with contact with customers, fine. IFRS is 15. Write what you know. Theory, then put it there. At least. One mark can take your debt premium, please. You can get 40. You need one. But as you have written that and that and that, and sometimes, oh, the person was serious. So, if you are not serious, you leave the blank spaces in the answer will collect like that. Hey, it's not about you. Okay. So, goods. There is goods as a performance obligation, and there is maintenance as performance obligation. Then, how much will the standalone price be? Or let's also identify the contract price. What was the price or transaction price or contract price? How much was it? 4.4. 4.4. Then how much will the goods supply to anybody be? If you supply the goods to anybody, how much would it be? 5 million. If you also provide the maintenance, how much will it cost? So that would be how much? 500,000. So the standalone price is 5 million and 500,000. So in all, the total standalone will be 5.5. But the person is paying 4.4 for it. You get it? There we go. So you have to be able to identify the obligation and identify the contract price in the question. As simple as that. And use what? The standalone to share the contract price. That is the next step that you have to do. So wherever that you do it, it doesn't matter. But the question normally is the income, what will be in the statement? What will be in the statement? But you have to do the calculation before you come to the statement. Okay. So let's share it. So here will be how much. And as you said, just do it. If you use your calculator to do it and it is right, it's okay. It doesn't mean that go and do 5 million over 5.5, it's waste of time, like you are saying. If you know how to do it, when you come here, just share it, and that will be the allocation. So the allocation is here. So just allocate it. 4,000. So here will be 4,000. 4 million. 4 million, and this is 400,000. Is that okay? 4 million and 400,000. And that one must sum up to be the contract price. And I will leave that. You say, you need to calculate, you are not going to do 5 million over 5.5 times 4.4 billion. The one also you flip. You are wasting the time. What you need is how much is supposed to be allocated. So if you can have your calculator and do it, it's okay. It's not like you go through the same process or no. When you I hope it's okay. So now, the recognition. Have you performed the obligation? So you go and look at the question. When the obligation is being performed, then you recognize it. So the financial statement, you are supposed to prepare it for the year ended 31st December 2019. 2019. So how much are we supposed to recognize now? And you are saying that they enter in the contract 1st October. 1st October. And they have to deliver the goods, right? So the goods delivery will be on October. So that one can be recorded. So they have already performed this one. But the maintenance is for how many period? For how much?
3 years. 3 years, 24 months.
For 2 years. So from that 1st October, 2 years, then you do the maintenance. And your accounting year will end only 3 months. October, November, December. So you cannot recognize all the 400,000. I hope you get it. So you have to only recognize how much? 3 over 24 months. 3 over 24 months. So how much will it be? 50,000 per class. Okay. 50,000. But they have received the money already. So the difference will be a different income. The difference will be a different income. Okay. So when you want to do it in the double entry, you are debiting your bank as they have received the money. You receive how much? 4.4. Right? You receive 4.4. Then you can credit their revenue. How much can you put under the revenue? It's only the 50 and the 4 million. So the revenue is going to be 50,000. 50,000. You get it? So that is this one and that one. 50,000. Then how much is remaining? Will be the deferred income. 350. So when you add it, you are going to get a 14 or 4.4. You get it? But that is not all. This one is not even part. The question says that the transaction has been included in revenue at 4.4. It's a Jurana or your account, but the 4.4 question revenue. But according to what you have done, it's supposed not to be 4.4, but 4,050,000. You get it? It's working. Do you know higher standard? So what are you going to do? When I ask your accountant, you have done standard, and they have made that mistake. So you do the correction. You do the correction. You have to reverse it. And you reverse it, as you know, accounting, you cannot cancel it. So they have done the account to the end. So what you have to do is to use the same double entry to do the correction. So the correction, they are supposed to take part of the revenue out of there. And how much are they supposed to take it out? 350. But you can say revenue, or you can say retain end. Normally the revenue will go down to be the net profit, and in the financial position you go to the retain end. You get it already. So we are going to debit the revenue figure or the retain end by how much? 357. Then you credit what? The deferred income. So this one is when the person tells you to account for it, then you do this. But when it has been done already and you're doing the correction, that is what you have to do. So this one, it has been done already. So you reduce the revenue figure or the retained earning by 350. Then you send that difference to the deferred income. So if it is in the statement of financial position, you have the retained earning figure there. So reduce the retained earning. It is still going to be the same. That is what accounting is funny. The retained earning and the liability are at the same side. So you take this one down and you add it to the other one. But classification is very important. This application of the standard is also a fraudulent activity. It's a fraudulent activity. So if you are doing the audit, the fraudulent, you have the financial reporting fraudulent and the misappropriation of the assets. And if you misapply the concept, it's also fraudulent activity. So you have to know what to do. Any question? Any question? Any question? So how is it going to be accounted for? Is this? Then you have to do the correction. You have to do the other one. So you justify the appropriate transaction for the above. It's supposed to be like this, but you do not do it like this. So you do the correction. Since it's already included in the revenue, then you have to take it from the revenue and send it to the deferred income. Okay. Then we have one here. Yeah, also here. Any question? We have to. I guess the book has been sent to all of us, the textbook, because you are going to follow a certain format for the final account. The book was on the platform, the financial reporting book. We send it on the platform. I say yes, send it to the analytical amount for space. So check it.
Some of us going to it as well.
Okay, so let's those who have it. How many of you have it? Yeah, because really we need our textbook. Go to the document and it's supposed to be there. In your okay, let me sign it. I want us to get the format so that we just use the format. Money or time. Standard, I was here, so I have RS5. Let's see the head. I was here on that house, and that is also important. I'm sharing the book. Then we have to look at the format. Please, the format is supposed to be followed strictly. And then my account and you have so you are supposed to follow the format. If you change it, it means that the answer is wrong. So even though why do we have to change it? That is not the question that you are supposed to be asking. I do as you want to do. If you have a question, not changing the format because it's a published account, and the published account we want consistency. We don't want a situation where the distribution cost will be here and others distribution cost will be at the other side. That is not allowed. One of the characteristics is to ensure consistency. So that's why we have to follow the format strictly. Okay, let me check it. Page around 4. The final account. I have sent it, please. It's 670 something pages. Three 5 9. It's 359. Yes. 359. 359. Have you seen it? Yes, I've seen it. And as you'll be listening up with the access, I some for my name. Okay, so that is preparation of a single entity's financial statement. Preparation of a single entity's financial statement. Have you seen it? It is not even on the platform for you, bruh. You say it now. Have everybody seen it? No. What's that? So please, you are going to learn the format. That is your formula. That is our formula to do that now. You must follow it strictly. You must follow it strictly. Otherwise, and I feel you. Are you there?
Yes, sir.
Okay. Madam is in. Oh, okay. It was hijacked in the waves. All right. That's it. So, when you are asked to prepare the final accounts, that means that we are doing it in accordance with IAS 1, presentation of the financial statement. Presentation of the financial statement. And the financial statement, normally the components or the elements supposed to be. Pardon? That is what I'm doing now. So it's also part of the standards, IAS 1. And that tells us how to prepare the final account, the preparation of the financial statement. So we are talking about financial statement now. Financial statement. If you can save your time, try to start it, because at any point in time, you say what will be the treatment in the financial statement. In the financial statement, we don't know financial statement. And we have been doing it like that. But the standard, the first one is telling us how to prepare the financial statement. And the elements of the financial statement supposed to be all the components. The elements supposed to be one, the income statement. The income statement. So the income statement will tell us the performance for that period, the performance of the entity for that period. But it also depends on the question. The question can also say that it's supposed to be statement of comprehensive income, or it can even be profit and loss. So whichever one, if it says income statement, it's the same thing. If it says profit and loss, it's the same thing. If it says comprehensive income, it's the same thing. So the question that will come in the exam will bring the question. So you don't bring your own heading. There's a requirement of the question in the exams that you have to write. As for this, it is copy. So you just have to copy the business name and you copy the requirement. Alright. Statement of comprehensive income, statement of profit or loss, income statement. So whichever one. The three of them, any of them. Then it's supposed to be for the year ended. Always, the question will even give it to you. So that's one. You are preparing it for a period. So for the year ended, will be in the question for you to just write it. And you are saying that you use it somebody to know the profit or the performance of the company. Then we also have statement of financial position. Statement of financial position. So this one is income statement, statement of financial position, statement of financial position. That will give us the assets, the capital, or let's say the equity and the liability. The statement of financial position will give us the assets of the business, the equity and the reserves, and the liabilities of the business. So it will give us a snapshot of the whole entity at a point in time. It is always asset. You control for the year, they have asset. So that one is at a point in time. What are the assets, what are the liabilities, and what are the equity and the reserves? Okay. Then you also have changes in equity. Changes in equity or statement of changes in equity. Let's do this. Statement of changes in equity, because it's normally a statement. Statement of changes in equity. So the statement of changes in equity is just a statement that will tell us the changes that has happened under the reserves and the equity in the statement of financial position. So we said that here that this one will give us assets, liability, and the equity and reserves. Then when it comes to the equity and reserves, we pick only that portion and come and put them here. So what is in the financial position as equity and reserve? We just want to know how the changes came. Maybe you transfer one from here, you add more shares or whatever. What changes came? So that one will tell us the changes in equity. Then we also have the statement of cash flow. Statement of cash flow. Statement of cash flow or cash flow statement. So that cash flow, some people will argue that why wanting ourselves to do the income statement, because normally the income statement is prepared on an accrual basis. It's prepared on an accrual basis. But for the cash flow, it is prepared on cash basis. That's how the company spend its money and how are the sources from which they receive their cash. So instead of preparing this on accrual, why don't you prepare the cash flow to know where the company gets its money and how it spends its money? So this one is normally prepared on that. It's only the cash payment and the cash receipt that comes in here. So that is going to show us the net cash at the end of the period that we have. So that is the cash flow. Then the accounting policies. the accounting policies that was used, and the notes and other notes, accounting policies and notes. So at times you have to explain one or two things in the notes so that anyone who is using the information is supposed to understand. We normally say that the financial statement is supposed to be understandable by the users. So sometimes if you don't give us the notes, it will be difficult for us to know the components of what you have done. So the notes were separated for us to know how we got those things. So here too, you have to tell us how you arrive at a certain figure and the accounting policies that you also use. When you are doing the PP, you say that you can use the cost model or the revaluation model. So which of them did you use? Then you give us the policy that you use in preparing or accounting for your PP. So any of them, the policy will come here as an explanatory note. It will also come here. The accrual concept also means that it's also a policy. Whether it's a breakup or a going concern is also in there. So all the policy, we have been told to go and read the theory portion of it. So please go and read it. Take 1 or 2 past questions and you will have the question has come and just solve it. It's not that difficult. Okay, so this is the component of the financial statement. So anytime that you want to get financial statement, this is what you will be given. If somebody also wants you to prepare the financial statement, that is what you are supposed to prepare for the person. So maybe you go to the bank and their financial statement is listed there. We see all these things in there. The income statement, the financial position, the cash flow, the explanation, the changes in everything. It will be there for you to know. Okay. And as we said, this is for publication. So we may prepare the account and it is not for publication, but the one that we are going to publish in the dailies or in our annual general meeting is what we are talking about here. So that one must follow the standard. That one must follow the standard IAS 1. That is what you're supposed to follow. Okay, so if it is the income statement, the first one, what and what are you supposed to show? So let's go down there small to page 360. 360. So what the item that you are supposed to show. So you have the business name, and the heading, as I told you, will come with a question. So the first income statement, whether profit or loss or whatever, when the question comes, it will be in. So the business name, then statement of profit or loss and other comprehensive income for the year ended 31st. They are combining in now. So you state it as such. For 2016, please, your first item is supposed to be revenue. The first item is supposed to be revenue. This time, you are not going to have 2 columns here. It's only 1 column that you have. So revenue is supposed to be first. You put revenue there, and the revenue is supposed to be accounted for in accordance with IFRS 15 that we have done. So the question they have, they give you additional information and says that the revenue, blah, 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 like what you have done. They recognize 4.4 in the revenue, and that is the standard in the question. So the standard may not come as a separate standard, it will be also here in the question. Then you have to tell them that you bring the 4.4 and you subtract the 350, right? So that there will be 4757. You put it there for them. That means that you have solved the revenue issue. Okay. Any question? You got this question in the format. Okay. Then the next item should be cost of sales. Cost of sales. Cost of sales. And the cost of sales comprises a lot of things. So the business, you want to be consistent. So all the direct cost of the entity, all the direct cost of the entity is supposed to be the cost of sales. The cost of sales. How you were able to generate that revenue. What are the costs that you incurred in order to generate the revenue? That is the cost of sales. So those who have done management accounting, we are talking about all the direct costs. All the direct costs. Even if you haven't done it, you are still saying the direct costs. All the costs that can be traced to a particular cost center or cost. So you put them there. And you bring it, bracket it. Here we are not going to say less. When the bracket is there, it means that we are subtracting. It means that we are subtracting. Okay? So when you subtract the cost of sales from the revenue, you are getting the gross profit. You are getting the gross profit. Then, after the gross profit, you go and look for distribution cost. Distribution cost. And what is distribution cost? Well, it means that the distribution and the selling is being put together kind of. It may also be that the person will tell you where to put the selling, but generally it comes together. So the selling will be all the marketing costs. All the costs that is incurred in order to attract the customers and retain them will be the marketing cost. Then the distribution will be the cost that is incurred for the goods to get closer to the customer. For the goods to get closer to the customer. That will be the distribution cost. So you look through the question, all the distribution costs, add them somewhere. Come and write distribution costs and put the figure there. So the addition somewhere will be the notes that we are talking about here. Okay. Then go to the administration cost. All the administration costs, all the costs that is incurred in order to formulate policies and the strategies for the achievement of the organization goal is the administration cost. So the question will give you the administration cost or the breakdowns. You put them together, send it there. All the offices cost is administration cost. Come and put them there. Okay. Then you add the two, not adding them as such, but the distribution cost is subtraction, the administration cost is also subtraction. You take the two out of the gross profit to get the profit from operation. Yes, please. Not really. The administration is administration. Right. Yes. So all the offices, the staff, some may be in the manufacturing, some may be in the distribution, some may be in the administration. So the offices that they don't really take part in the turning of the raw materials in finished goods. Those that are for strategy, position, stationary kind of standard letters, administration. All right. But for the formulation of policies and the implementation of it will be the administration cost. And so we get the profit from operation. Profit from operation. At times there may be other income that we did not put it there. Maybe an entire mistake. So if there are other income, that is not revenue. You said that any increase in an asset is an income, right? So if there is any other income, let's say profit on disposal of fixed asset, then it will come and add to the profit from operation. You want to know, yes, we want to know the actual operational profit, and that is the profit from the operation. But any other income that is not the core business of the entity will come here. So after the profit from the operation, then you bring in the other income. I hope it's okay. An example of the other income is what I'm giving you. Profit from sale of fixed or PP, fixed asset. Any other income. Or it can even be profit from associates. If it is not actually consolidation, but you have under associate, any profit from the associate, it's not the core business that we do, but their profit is supposed to be part of our profit. And it will come under here. After the profit from operation, you bring in profit from associate. So any other income that will accrue to the business will come that side. I hope it's okay.
So supposing the company has invested in this.
Yes. And that income from that investment will be here. Yeah, I'm fine shipping permission. Yeah, I'm fine shipping people also. So when you go and meet it, it's not like it's not going to be part. It's part of it.
those kind of income.
No, it depends. Other comprehensive income takes a new kinds of things.
So the profit from the associate,
Yes.
it's like that means the subsidiary or
No, we have subsidiary and we have associate. Why are you consulting here?
so we also have and we have a question that
No, when it is an associate, we consolidate. So you cannot tell me that profit from a subsidiary. I mean, it's going to be something. But profit from associate, which the figures were not consolidated, will be here. It has one line item, profit from associate. I don't know whether the format that we give to you, after the profit from operation, then profit from associate will come. So anytime it will be below profit from operation. Then it comes. Before the finance cost. Before the finance cost. Okay, any other question? Shall we continue?
So who is going to be after profit from operation? So you get like
Other income. Yes.
Some bank
Other income will be added. It's other income which will be added. Other income will be added. So you have profit and other income. But as I said, you want to separate the main profit on the core activity that you do from the other profit that you are getting. So it may be that you are getting your salary, but somebody is also giving you something. So when you are doing the accounts, your salary is what you spend for. Then you can later add the other income to it. You don't want you to add the other income to your salary and come and deduct. No. That is what not the standard says. So the revenue here supposed not to comply with your salary and other income via only your salary. When you do the deduction, come down there and you have still remaining amount and you add the other sources to it. So that is what the account also is. So after the profit from operation, then you add other income. So anywhere that you are receiving any income, so profit from sale of assets, associate profit, profit from investment, profit from wherever, come and add it here.
so what can you be a loss?
And the same thing, yes, you subtract. If it is a loss, you subtract. I only encounter loss. But if it is a loss, you subtract. And a loss is a negative, so you have to subtract. Okay. Then you come with the finance cost. And the finance cost is supposed to be finance cost. So if the person, if it is interest payable, you change the name to finance cost. You change the name to finance cost. Interest payable, right? You change it to finance cost. Then perceive only interest payable here. So all the interest that you pay, all of that, whether it's from lease or from loan that is contracted or whatever, debenture or whichever, put them together. Come and write finance cost. I hope it's okay. Alright. So that is that. So the other income can also take finance income. The other income can also be finance income, right? Finance income. Maybe you are also giving a loan and you are receiving the interest. So you can also term as finance income or the other income. Okay. Then when you take the finance cost from the profit from operation and other income, you are going to get profit before tax. Profit before tax. I said profit from operation, you add other income, then you take the finance cost, right? So when you take the finance cost, you have to also get another heading. And the other heading is profit before tax. Profit before tax. Then below the profit before tax, you have the income tax assessment. The income tax. And you have done income tax already as a standard. And that is what IAS what? 4. So with the income tax, it's also a new standard. So within the question, there is also going to be a standard on income tax. You get it? So please, for PP, revenue, income tax, that finance cost, it may be that financial instrument, or it could be a lease. As for that, even though you may not meet it separately, when you come here, you may also meet it. Ah? And you know, you know, as we are going, then we are mentioning it. Because there are some basic ones that you are supposed to know, because if it's not falling on it's separate, it will still come and meet you here. So PB, inventory, revenue, income tax, the investment property can even be there. Impairment can be there. Intangible, there are a lot of them. Geometry when you go outside, you know. Oh, so much.
So say the standard scans apart from the
Yes, apart from separating it in question 2, it can also come here. So you have to understand the principle and come in. Because when you are saying income tax, you are saying that the tax payable for the year supposed to be the tax for the period under or over tax provision, then the deferred tax. So in the question, additional provision 2, the tax for the year will be given to you under our provision, deferred tax calculation may also be there. Then you have to calculate and add and come and put it here as a note. But it may not be difficult as a separate standard. But you have to understand the same principle and apply it. Okay, let's continue. So you supply the income tax and get profit for the period, or profit for the year. Sorry, for the period or profit for the year. Then you continue because the heading is statement of profit or loss account. So profit for the year or end is statement for profit and loss account. Then other comprehensive income, you can have another heading. And the other heading is other comprehensive income. Other comprehensive income. So other comprehensive income will be there. So other comprehensive income may come with if there's any gain on property revaluation. When you were doing the PP, you said that gains, the first gain or increase in that will go to other comprehensive income. Right? If there is a decrease, it will go to income statement. If there has been increase or decrease before and all it can come. Then you have to know how to reduce it or whether to add or so. You have to understand the PPE principle. Then, if there is any income tax related to the revaluation, you have to also take care of it here. Because some of the tax, because of the deferred tax element in it, the revaluation will also cause another deferred tax. That tax that relates to deferred, what do you call it? The revaluation supposed to come to the revaluation in here. But I didn't which is okay. But all that we are saying that the deferred tax, there is going to be a deferred tax when the carry amount is different from the amount that the tax experts are saying is supposed to be amount. Right? When the carry amount is different, then there is a deferred tax. So the deferred tax, because of revaluation, there can be that the carry amount is more. Then the tax officers, they don't recognize any revaluation. So the deferred tax will be more. So that portion, that is as a result of the revaluation, it must come here. It will not go to the income tax up there. It will come to down here. And that is what I'm saying. But maybe you have a question. One question is like that. You see what you okay. Then if there is also other comprehensive income, because gains on foreign exchange and those kind of things all may be under the other comprehensive income. So all of that together, then we get the total comprehensive income for the year. The total comprehensive income for the year means that the profit for the year plus other comprehensive income total will give us the total comprehensive income for the year. So profit for the year, that ends profit and loss account statement. And the comprehensive side, the total there, when you add the two, it will give us total comprehensive income for the year. Okay. Any question? So that is the net of tax. That would be this figure. Then we add the profit for the year to that to get us the total component. This one is the tax. The tax income capital. So the net of tax added to the profit for the year will give us that. Okay. So that is for the income statement or the profit and loss and other comprehensive income, depending on the heading. Let's go to the statement of financial position. How the format. Statement of financial position. We are going back small, page 359. And the heading is supposed to start with assets. 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 Should be the first one. Then the next one is supposed to be non-current assets. Assets. Then you come to the next line, and that is non-current assets. You don't start with non-current assets. You start with assets. Then you come to the non-current assets. So the non-current assets, normally you see that anyhow that you put it, it's also okay. But others, you start with goodwill, the intangible first, and come with the tangible on next. Or the tangible and mix up with that. So you bring in all the non-current assets in the question. And you're supposed to come with the carrying amount. You have to do your calculation somewhere and bring the carrying amount. One figure. That is what you're supposed to do. Okay. So we have the PP, and all the PP must be put together. The property, plant, and equipment, all of that is supposed to be under the heading property, plant, and equipment. You are supposed not to separate it outside first. Maybe you have equipment, you have motor van, you have premises. No, you put all of them together. Do the asset table, bring the totals there. Okay, on the schedule, and bring the total. Then we have the goodwill. So all the intangible, you can also have a schedule for the intangible and bring it. Or if you want to separate it, that is okay. But you know that for the PP, you have to bring it together. Okay. Then we have other intangible assets in there. We put them together. So that will give us the total non-current asset. We come to the current asset, and inventory is supposed to be first. The trade receivable is supposed to be there. Then the cash and cash equivalent. So the cash and cash equivalent is supposed to be there. So all the bank and the cash and the any amount that is going to be received within a short term without changing the value. So it may be that you have a short-term investment, but when you are going for the money, they will not deduct so much significant figure from it. If that is the case, it qualifies as cash and cash equivalent. So it's supposed to be in. That's short-term investment. Short-term investment supposed to be there. Okay. If it is a long-term investment, it's supposed to go to the non-current asset. Okay. Then you add the current asset and the non-current asset total to get the total asset. Total asset. Then we come to equity and liability. Another heading, equity and liability. So the equity and liability will start with capital and reserves. Please, you are not going to start with equity. The heading is supposed to be capital and reserves. And the capital and reserve, we have the equity section, which is the share capital, the retained earning, other component of equity, any other reserve, depending on what the person will give it to you. So the same schedule will be also in the changes in equity. So the heading is supposed to be capital and reserves. Capital and reserves, not equity. Capital and reserves. So we bring in the shares, the retained earning, and other equity reserves. So you have the total equity. I mean, the total is not capital and reserves. The total is supposed to be total equity. One thing has and because that is how the standard wants you to do it. So far as you are down here, you don't have any authority to change it. When you are up there, then you can tell us what to do. So you bring in the total equity. Then the next one is non-current liability. Non-current liability. So the non-current comes first before the current. and current liability. So long-term borrowing, deferred tax too is also here. If you have any debenture, it's also here. You put them together. You come to the current liability, and with the current liability, you have to bring in the trade and other payables. So with the what do you call it, the access to, you can have trade receivable, which is the trade and other receivable can be put together. So if you have the assets, there are other receivable. Here you don't have prepayment, because prepayment is a current asset. You don't have any prepayment figure here. We call it trade and other receivables. Trade and other receivables. Okay. So in the same way, you don't have accruals, owings, outstanding. You see what? Trade and other payables. You don't have heading for any outstanding or whatever. Put them together there. Okay. Then we have the current tax payable, which will be paid within a short term. Then any short-term provisions. That means that IAS 37 provision, contingent asset, contingent liability can also come in there. That's not a separate, but part of this question. Because provision will be there. Okay. So you put the liabilities together, you get a total liability, and you add it to the capital and the reserve figure, which is the total equity, and you name it total equity and liabilities. Total equity and liabilities. The head is supposed to be equity and liability. Then down there to come total equity and liability. So that will end the financial position. That will end the financial position. Any question with that? Any question? Okay. Then go to changes in equity. The changes in equity on page 360. Changes in equity. So we also had a statement of changes in equity for the year ended. And that is there. So please ask for that. The examiner will give you the headings. So you pick the equity and the capital and the reserve side. We have done the financial position already. So you go up there, the capital and the reserves. Have you seen it? Here you have the share capital, retained and other components of equity. Have you seen it? That is what you are coming to spread here. So the person will give you what you are supposed to head. So you just have to write changes in equity or statement of changes in equity. And the heading, the share capital, if it is up there, you bring it. If there is share premium there, you bring it. If there is revaluation surplus, you bring it. If there is retained earnings, you bring it. If it is general reserve, you bring it. Whichever figures are there or the headings there, you have to come and put it under the columns. As simple as that. So that there is no columns, that is enough. It depends on the question. The question will give you the columns that you have to bring it. Then you shouldn't forget about the total. The total must also come. The total must come. But as for the total, you don't even use it. The down there is what is important. But you bring the total. So you bring the opening balances from last period, for whether it's for shares or premium or the retained, and then any changes that you have done. So at times we said that the revaluation surplus part can be transferred to the retained earnings. When you were here, we told you that reclassification of the revaluation surplus to retained earnings, and we said that you can use two different methods. Either the surplus divided by the useful life, then you transfer it each year, or you calculate the depreciation before the revaluation, depreciation after the revaluation, the difference will be classified. So the amount will be classified. If the person gives it to you straight, take some from the income surplus, or let's say the revaluation surplus to retain, and you just take it. But if it is reclassification, you have to follow the standard. Okay. Then the profit for the year will also be added in the retained earning. The dividend paid will still be there. If there is new issue of shares, it will still be there in the changes in equity, statement of changes in equity. Then you add each of them, the columns. So the share capital, if there has been any issue, you do it. The premium, if you have added anything, you add them together. So you subtract or add depending on whether the dividend payment must also be there. Then you are done. You bring that to the closing balances. And you have finished with the statement of changes in equity. Any question with that one too? So according to the questions that normally comes, it ends here, the final accounts ends here. Then if the final accounts is not coming, the cash flow comes. So maybe when you finish the final accounts question, then you can go for the cash flow, know the format, solve the question. So that if the final account doesn't come, the cash flow comes, you know what to do. So the three of them, or the whole financial statement as such cannot come in an exam. The cash flow will be a separate exams, and the other ones will be in one exam. So you have to learn any of them. So as for the final accounts, statement of financial position, the income statement, the changes in equity, and the sum of the notes, because you'll be doing the calculation, you have to bring the notes. Then the statement of cash flow too may also come. Then it also comes with the notes because of the calculation that you do. All right. So let's solve one question from the same book. Page. So we are going to do. Okay, 456. 456. Page 456. I think it depicts some of the things that you're supposed to know. So 456. I'm going to say, a bit nice. 456. Yes, yes. Question 22. Four, five, six.
Five. Prepare the following information in a form suitable for communication of the trading limited. Limited financial statements for the year ended 1st May 2020. A. Statement of profit or loss. B. Statement of financial position. C. Statement of changes in equity.
So that is a requirement. That is a requirement. Profit or loss, financial position, and the changes in equity. Okay.
The trading limited has prepared the following draft financial statements for your review. For your review. For the trading limited statement of profit for loss for the end. Additional information. I. Income tax of 2.1 billion is yet to be provided for on profit for the current year. And unpaid under provision for the previous year's liability of 400 Ghana cedis has been identified on 8 June 2020.
Okay, so let's, in order not to waste time, let's just start. So that as we go along, we do it. So the name of the business, the trading, and the requirement A is what?
statement of profit or loss.
Statement of profit or loss account, right?
Yes, sir.
For the year
Firstly,
31st May 2020.
yes, sir.
Okay. So as such, then the currency sign is Ghana cedi, right?
Yes, sir.
Is it huge? Should we put reserves at the top? Okay. So that as you move, then you just continue to play. It doesn't mean that you have to do the first one before you go and do the financial position. It doesn't have any what do you call it? An order for you to do. What you have to do, if you know what to do, just do it. If you think that the financial position will be fast for you to do, we want the max. We are not saying do all. 100 account. So you understand need to pass and go. But if you think that you are familiar with the financial position tense, go and do it. There are some of them that you need not to work any turn around it. So just be fast. Don't waste the time. But if you complain that you cannot do it, the time is not there, well, you are just complaining. You see, can answer. Okay. So let's continue. So the first one says what? So always there is going to be a revenue. And the revenue is what?
30,000.
Let's wait a while. We don't know whether some of this thing will be added. So let's move on to the additional information.
Additional information. I, income tax of 2.1 million Ghana cedis is yet to be provided for on profit for the current year and on pay under provision for the previous year's liability of 400 Ghana cedis has been identified on 5th June 2020 and has not been reflected in the draft accounts.
Okay. Please, again, to when the question is coming, it can be in two forms. You see that this one, there is income statement that has been prepared and financial position that has been prepared. At times, a trial balance will be given. Instead of this trial balance, you know how a trial balance is. The debit and the credit and the items are in. Revenue, purchases, whatever will be in. Then you have to go and do your fresh account. So it depends on how the person is framed. Any of them, you are going to follow the same thing. But you have to get your format in your head so that you can depict them as you move. Okay. So it says that there is income tax. Income tax of 2.1 is yet to be provided. So it means that up there is no income tax. Up there is no income tax. Okay. Because from the format, they are supposed to subtract tax for the period. Okay. So let's try to do the income tax. So note 1, it means that this one will pick the first page. The financial position will also pick the second page. Then half of it, maybe even half of this one can pick the changes in everything. So you have to be a little bit strategic. The changes in everything because of this one is not going to be that too long. So half of it can take the changes in everything. Then we bring the next page to the notes. To the notes. Then the notes, you have the first one as income tax. Income tax. And the current tax provision. Current tax provision is how much? 2.1. If we are still having the 3 zeros at the top, it will be 2,100, right? 2,100. Any question with that? Then let's move on. What does it say again?
Under provision.
Then there is under provision. Under provision. From previous year. And under provision, do we add or subtract? Yeah.
Under provision.
How much is the under provision?
400,000.
Okay. I'm around. Any question with that? So if it is over provision, that means that is subtracted. It is under provision previously. What we provided last year, when the GRA also assessed, they said that we are supposed to pay more, right? We are supposed to pay more. And if we are supposed to pay more, it means that last year's tax provision was lower. That means that we have to add what we are supposed to have provided and we do not provide to this year's tax. Okay. So that's why we are adding. If it is under provision last year, it means that we provided more. And the tax officer says that no, it is too much. So we have to take that balance out of this year's provision. I hope it's clear. Notwithstanding, it is still under the IAS 12. So those who understand it are supposed to understand it. Notwithstanding, if you don't understand, when you go and it is under provision, just add. When it is over provision, just subtract. You are good to go. Nobody will ask you for any explanation. They don't need it. I hope it's simple. Okay. If there is also a deferred tax in it, that means that you will bring it. So let's wait. Maybe there will be deferred tax in the additional information. We don't know. Okay. Let's move on.
There have been no additions to or disposals of non-current assets in the year, but the assets under construction have been completed in the year at an additional cost of 50,000 Ghana cedis. These relate to plant and machinery. The cost and accumulated depreciation of non-current assets at 1st June 2019 were as follows.
Okay. So it means that we can do asset schedule or PPE schedule so that you know how much you are supposed to transfer to the PPE, how much depreciation is supposed to be in, how you have to account for the depreciation, and all those kind of blah 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 blah. Okay, so let's bring in the asset table. So 2 EPE schedule. But I won't try to read now. Okay. PPE schedule. So what you have to do is normally you put the assets in columns and you bring the totals also in there so that it will be simple for you. So what are the assets under the PPE?
We have freehold
Land and building. We also have what?
Plant and machine.
Plant
Machine.
and machinery. We also have what? Fixtures and fittings. Okay. Then what again?
Assets under construction.
Assets under construction and construction. Okay. Then bring your total. Bring your total. So that is the columns that you have to create, and the person will give it to you. And the money. Then you start with the items as such. As at that date, there is a cost there. Okay. So cost. What was the date? Or no date was given? Okay.
1st June 2019.
Okay. So the cost was on 1st June 2019. And how much was the cost for freehold?
19,000.
18,000. Still 3 zeros at the top, right?
The land element is 10 million.
Oh, yeah, let's put them together since here. If there is a revaluation kind of thing, you can see.
Say, assets and liabilities.
Let me come. Under construction. Assets under construction. And a total. The quantum machine, 2100, right?
Yeah.
Fishes and fittings,
10,000.
10,000. Assets under construction, 400. Okay, that's at that time. We can add it together. How much are we having? Total. Total. Four, 9, 500. Okay. 49. Any question with the asset table? How you do it? Okay. Was there any accumulated depreciation as at that time?
Yes.
Okay. So the depreciation as at that time. Accumulated depreciation.
And
The land and building, the freehold, land and building, how much is the depreciation? 3,000. So the depreciation will be subtracted, right? Okay. Then the plant and machinery, 4,000. Fixtures, 700. Assets under construction.
no.
Dash. You cannot even have depreciation on asset under construction because you can only depreciate an asset when it is in use. Do the bishop of our wedding? As you go, I check some person the bishop.
I need to ask why like they didn't finish with maybe like additions and everything cost.
No, this was given at the beginning and this was also given at the beginning. That's why. Or we could have bring the carrying amount and continue. That one. Okay. But it's like they gave it to us, so we are just copying the same thing. We just see and here. So let's find out the carrying amount. Let's find out the carrying amount. And the total here will be how much? So that 10,000. 10,000. Okay. 60,000. There will be 16. No, yeah. Okay, 16,000. There will be 6,100, right?
Yes.
There will be
There was
8.
636.
Ah,
No,
That means
6,300, 400. So it's 400, 400. And there will be
that's 18.
38, 800. 38, 800. So that would be the carrying amount. As at what time? That's the first 690. The carrying amount. Any question? Any question? All right. So let's go to the details. What does it say? The additions for the year and the changes or what?
50,000 additions.
I will need that portion so that everybody will see.
There have been no additions to or disposals of non-current assets in the year. But the asset
800. 49,500. Is it 30 or 40? They are 38, 800. And then I say, oh, China, now go to Asia, we China, go to Asia.
But the asset,
Please understand it first.
but the assets under construction have been completed.
No, read from the top there to that.
Again, there have been no additions to or disposals of non-current assets in the year, but the assets under construction have been completed in the year at an additional cost of 50,000.
So there is no addition, there is no disposal. However, the asset under construction has been completed with an additional cost of 50. And no addition here. I don't know how to say that. Okay, so there has been addition on the asset under construction. This no addition, asset under construction that we have an addition of how much? 50. So here is also going to be 50. I hope it's simple. So when you read it one after the other, I know they come into my answer, but you have to be fast, understand it and move on. Okay, so, and that asset has been completed and it was reclassified, kind of. What does it say?
This relates to plant and machinery.
Okay, so this was an asset under construction. We have completed at the cost of 450. That means that we have completed. And it says that it relates to plant and machinery. So when it is under construction, we separated it. But now that it has been completed, we have to bring it back and add it to the plant and machinery. So that means that we are reclassifying it. Reclassification. So we are reclassifying the asset under construction, which its total is 450. We are sending it to a different heading. So you take it from there and come and add it to the other one, as simple as that. So reclassification, it will come under not freehold, but under plant and machinery. I hope it's okay. Yeah. So that's to give us dash. So this one is addition, this one is subtraction, it will be 0. Any question? 7. Okay. We continue to read.
There is a revaluation of land and building.
There was a revaluation of land and building
Okay.
during the year, creating the revaluation reserve of 5 million cedis,
Okay.
which is land element has 1 million cedis. The effect on depreciation has been to increase the building charges by 300,000.
Okay, let's take care of the revaluation gain. Yeah. That there has been a revaluation of the land and the building, and it has caused a gain of revaluation gain. Revaluation gain. And it has caused an increase of how much? 5 million, sorry. 5 million. So the land and the building has been revalued. Even though it may be that you have to separate because of the depreciation. But the bulk will be there. So that when you're doing the depreciation, so you know what to do. And it's even calculated it for us. So it's not going to be difficult. But the gain will be in the freehold land and building, which is 5 million. You get it? 5 million. Just do that one first. The gain on revaluation, 5 million. Is that okay? Okay.
The effect on depreciation has been to increase the building charge by 300,000.
Okay.
Beijing Trading Limited adopts a policy of transferring the revaluation surplus included in equity to retained earnings as it is realized.
Okay. So let's know how to calculate the depreciation for the year. The depreciation for the year, was it told? The depreciation for the year.
Yeah. An analysis of an analysis of depreciation charge shows the following. Buildings, 50% production, 50% administration.
Okay. And so then here we additional information that we have.
Plant and machinery, 2,500. Features and fittings also 30% production, 70% administration.
Okay. So let's check the depreciation there in the income statement. The profit and loss. Go up there and see. Have you seen that there is depreciation? Have you seen it? Profit and loss. Go up, go up. Have you seen it? Yeah, you will be in
4,200.
So that depreciation over there, that's what I'm talking about. So that depreciation is the depreciation for the year. The depreciation for the year. Then we have to know how to calculate the depreciation for that. So for the year, we can see depreciation. That is 4, how much? 4, 5, okay, 4 to 5, 7. That has been calculated for us, but we have to be able to separate it and know how much. So we can try that will go to PP, and that is okay. So sometimes, now I say I deny PP, but the total balance will go to PP. So why worry myself if I cannot even separate them? You get it? It's the balance that comes in the actual. But it doesn't mean that you know or you don't know. The depreciation for the year is here. And that one will be in the income statement. Fine. Then it is in the income statement. Then you have to subtract the depreciation for the year from the carry amount to get the closing balance. Is that not what it says?
Yes.
So that the closing balance will go to the statement of financial position. So if I'm there, I can even separate it. Let's get the figure and move on. Because I don't need to break down for any other thing, actually. But let's know how to calculate it. Yes, I'm saying that. Just be fast. Let's be fast. So the calculation. How does it say about it? The depreciation calculation.
Buildings, percent production and
That one is allocation of the depreciation. The total, it is showing how to share the total, right? But that, let me see. Yes. So it is telling us, because we are going to have the cost of sales and these kind of things here, and that is showing us how to calculate the depreciation for each of them. So the building will have to 50% to go here, another 50%. The machinery doesn't have. The fixtures and fitting will go. I don't know it's different. But let's go to where the asset is. Let's read the II again.
there have been no additions to disposals of non-current assets in the year, but the assets under construction have been completed in the year at an additional cost. This relates to plant and machinery. The cost and accumulated depreciation of non-current assets as at 1st June 2019 were as follows. We have a freehold land and building, land and machinery.
Okay. Then the II.
There was a revaluation of land and building during the year, creating the revaluation reserve for 5 million Ghana cedis.
Okay.
One element of 1 million. The effect on depreciation has been to increase the buildings charged by 300,000 Ghana cedis.
Okay. So that means that the building depreciation is supposed to be that the changes which has been to be the 300 is what has been catered for. So let's know the amount that's supposed to be in there. This one has pushed 5. So for 2020, which is for the year, how much depreciation should we send to the building for the depreciation, and how much should we send to the, what do you call it? The plant and machinery and the fixtures and fittings? That is what you are supposed to check. So let's do the earlier on. How much was the calculation? These figures, which was there. We have to know the value, the percentage rates, so that we can use it over that balance which is here, as we add this one and the other ones. So if the building, yes please.
The statement that they provided one
Uh-huh.
for 2020.
Okay, 2020 figure.
Since there was 45.
Yes.
In addition to next to is saying that this 45 year agreement, the analysis shows, so I think they already given that.
The breakdown.
Yes.
Okay, the analysis of the depreciation charge, that is V. Have you seen it?
That is what I read.
Okay, the final figure down there is supposed to be the depreciation for each year. Have you seen it? V. The analysis of the depreciation charge shows the following. So the building, the depreciation. The plant and machinery, the depreciation. Then the fixtures and fittings, the depreciation. Have you seen it? So we come here and the depreciation for the building is 1,000, not the separation. Have you seen it? Are you there? But the breakdown will come here when we want to share the depreciation for the year. Then the second one, 2550. I guess the person wanted people to pass. That and that. Sorry. The person will give you a useful years, and the useful life of the asset, and it tells you to do that and that and that. That one is also there. So you have to know how to just calculate depreciation. And from the PP, we said that the depreciation is the carrying amount or the value of the asset as at that time divided by the useful life. Remaining. The remaining value of the asset divided by the remaining useful life. And that will be give you the depreciation. I hope it's simple. But this one, it was given to us that the 4,250,000 is going for plant, what do you call land and building. The 2,550 is going to plant and machinery. The 700 is going to fixtures and fittings. It has been stated there. So we just come and put them and put them there. I hope it's okay. As for the asset and the construction, you have really transferred it to the other side. So there is no need to do it to the system. And the total will be the 4,250. So let's get the carrying amount as at that time. That is 31st December 2020. 31st December, 31st May. May is month.
20,000.
So the total here is just 60 minus plus this minus that. 20,000. 61 plus that minus that. 14,000. Okay. 14,000. The next one,
5,600.
5,600. This one will be dash.
39,600.
29. 39,600. So the 39,600 will go to the statement of financial position. Okay. Any questions? Question 9, said I hear you. I said I hear question name. I said I hear question name. Okay. The main question is to do the income statement, statement of financial position, and the changes in everything. You know more than calculations. That means that I haven't. But that's why I want you to start with the heading, so that everybody knows that you are willing to do it. But if you just start with the calculation without using the headings, then it's like you are not doing it what you are supposed to do. Even though the marks, some of the marks will be given to you, but the main thing is this is what you are supposed to do. So do that one and leave a space, go and do the calculation and come back. Rather than saying that I'm doing all the workings and before I start with the exams. No. Okay. So revenue. We have gone through all the additional information, right?
So the current amounts, we were already having them in the question.
Are you sure? That's the same thing.
The statement of financial position as at the 1st May 2020. We will run the
Yeah, it is there, but when you're doing for presentation, you don't separate it. Right? You don't separate it, you have to add it together. Like fine, this one is there, this one is there, this one is there. But we want to know how you arrive at these figures. And the total is supposed to be the one that you are supposed to use in the statement of financial position, not the individual. So they prepare the accounts, you have done financial reporting, so come and do the presentation of the financial statement based on the standard. That one is not in accordance with the standard. So you come and do the what is in accordance with the standard. You get it. So even though it's in, the schedule is supposed to be like this, as a note. Then you do it. Then you send it there. Okay. So let's do the revenue. As we went through the additional information, the revenue doesn't have any adjustment. It doesn't have any adjustment. So we can bring the revenue there. The revenue is 30,000. Is it 30?
Yes.
Okay. So it's 30,000. So we can put the 30,000. I hope it's okay.
Sure.
So you are done with the revenue. Then you go to what? Cost of sales. As for this question, it has been given. So you could have added and it's okay. Right? But you have to go through the additional information to know whether it's going to be exact or not. Maybe they did something wrong. So you have to go through. Just fast net, you do the fine. So the cost of sales, how do you then get the cost of sales? Or is the cost of sales given? Not really. There's raw material consumed, manufacturing overhead, increase in inventory, observation, staff costs, but you have to get the cost of sales. You have to get the cost of sales. If you know all the items there, the distribution cost from one work format, but it is given. So you have to go and do another workings and bring in the cost of sales up there. So let's look at the allocation of the expenses. The allocation of the expenses. Allocation. Okay, let me bring it. I have the second one. Senior, how many do you have? But okay, allocation of expenses. Allocation of the expenses. We want the heading to be as in the format. We want the heading to be as in the format. So let's pick the headings in the format. We have the cost of sales. Cost of sales. We have the distribution cost, right? Distribution cost. We have the administration cost. Administration cost. So that is the headings that we want. So let's pick the first item in the income statement as is given in the question. What is the name of the first item? Raw materials.
Yes.
Apart from the revenue. The cost there is raw materials. Raw materials consumed, right? Okay, raw materials consumed. So which of these headings would the raw material consumed be? And so we just have to allocate the cost to it. Afterwards, we add it together and you're good to go. I hope it's okay. So the cost of raw materials consumed is how much? Put it there. Then go to the next one.
Manufacturing overhead.
Manufacturing overheads. Manufacturing overheads. Where will it be? Cost of sales, the amount. 500 or 5,000. Just answer now, they are one or two. I hope it's simple. You just want to allocate it in accordance with the standard. In accordance with the standard. Yeah, they are saying that the cost of sales, all the cost of manufacturing, and other direct costs. Because if you are doing cost accounting, the material cost will be there in the direct cost. The manufacturing overhead is also factory overhead. It will be under the cost of sales. So all the manufacturing things will come under the cost of sales. Okay, the next one. Increase in inventory of overhead. Of So that is increase in inventory. What does it say? Increase in inventory. When you are doing at the lower level, you say opening stock. Then you have the closing stock. So if there has been an increase in the stock, it means that the opening is smaller than the closing. Get it?
Yes.
The opening is smaller than the closing. So that's why there is an increase.
Yes.
So that increase in stock will be how much? How much does it say? 1,400. So if it is a decrease, then it's going to be added. If it is an increase, it means that you have to subtract. Because the closing is more than the opening. So the closing is normally subtracted. The closing is subtracted. We have to check the difference. Do you get it? Read that section. Because if you haven't seen it, you need to go to this one. Increase in provision. Increase in inventory. Increase in inventory. So if the opening is say 5,000 and the closing is say 7,000, that means that there has been an increase of what? 2,000. And if you are doing the opening add BGCs and those kind of things, it means that if you want to take the net of the opening and the closing, it will be 2,000. And the 2,000 is supposed to be subtracted from the BGCs. Because when you add the 5,000 and you take the 7,000, it will still take it from the BGCs. You get it? So that is why the material, then if there is any stock increase, you have to reduce it. If it is a decrease, it means that you are going to add. So if this one is 8,000 or 10,000, this one is 7,000, the difference will be added to the purchases because there will be an opening stock there. Get it? Let me tell you, 200 is for sure. Nobody will ask you for the explanation. So if it is increase, subtract it. If it is decrease, subtract it. We now have another flex zone. No, you add. Yeah. So if it is an increase, but when you are going to go to cash flow, you are also going to see that dynamic. Now, if there is an increase in inventory, it means that stock cash will be going up. So it's almost the same thing. It's the same reduction. All right. Any question with that? Then we go to what? The next item. Okay, so staff cost. So the staff cost, how are we sharing it? The sharing was given down there. So it's supposed to be 70 for factory. So the whole staff cost, 70% is for the factory. And the factory is where? In the cost of sales. And 20 is for general administration. Then for distribution. To get it. So it's going to be 70. As for I have changed it. So 70, 10, 20. 70, 10, 20. So share it and let's go. Share it. Amount there is 4,700. So share 70%. 8,290. 10%,
10% is 470.
20%,
20% is 940.
what shall you do? So, the next item, distribution cost. You know, see, the China, because so distribution cost is under distribution, right? How much? Round, you put it under distribution straight away. Then the next is depreciation. Depreciation too, you are supposed to share it. And it was given down the 50 to that section. So 50 for where? Yes, please. So the building depreciation was separated. 900. So the depreciation was separated into different items, right? Or different assets. So let me bring the building first. The building, you are sharing it in what ratio?
50% reduction.
Administration.
Okay, so the building depreciation was 1,000 for the year. You saw it? 1,000 for the year. It's even in the question, but it's the same to it. So 1,000 for the year and 50% here, 50% there. So 50% in the cost of sales will be 500. And where? Administration?
Yes.
500. How be simple. Then what again?
Plant and machinery.
Plants and machine. The depreciation is 2550. 2550. It's in the question. The depreciation for the year. How is it? 2550. And you are supposed to share it in what ratio? There's no ratio. So you have to use your own discretion in the plant and machine. Plant and machine. Where will it be? Under the three heading. Plant and machine, where we are manufacturing the product. Plant and machine will be where we are manufacturing the product. So it will be under cost of sales. Do you get it? So the 2550 will not be shared. It will be given to the manufacturer. The manufacturer pays the cost of sales. So those who have done cost accounting know that plant and machinery, when you are sharing its maintenance or whatever, it will go to the manufacturer. It's a direct cost to them. Nobody is using plant and machinery. But sometimes equipment may be at the office. But plant and machinery is a whole plant that you are using to manufacture what you have to manufacture. So it will go to cost of sales. Okay. Then fixtures and furniture or furniture and food. Okay. Fixtures and fittings. Fixtures and fittings. And the depreciation is 700.
700.
The sharing ratio.
30% reduction.
So we're 30% under the cost of sales. 210.
70% administration.
Under administration. Okay. So under administration 490. That is 70%. Now they run our office in longer transfer. If there's fan, there's air conditioning, those kind of things. It's fixed against the wall and those things. So majority of them will go there. Okay. What again? Let's finish. But there are other cost items. Interest payable and so. But the actual expenses is these ones that you have to share among them. Any question? Any question? The fixtures and fitting figure is at the top there. Sorry, the depreciation, or even in the additional information. The additional formation V. The additional formation V. Facials and fittings, 30 production, 70 administration, and the amount is 700. Have you seen? The amount comes with it, 700. This is what the same side. The V. So you have the building, 50, 50, and the amount is 1,000. Once the machinery, there's no percentage, 2,550. And you have fixtures and fittings, 30, 70, and the amount is 700. So the 700 that you are sharing, all those ones is what you are sharing. So the depreciation figure was given up there. Then you have to come down here and know the separation and share it according to the schedule that was given. So we add it together. Let's add it together. How much cost of sales? 9, so this one will be 4, 8, 70, 4, 6, 70. And they get my
19.
Form. So this one is 13, 17, 19,
650.
6, 5, 7. Okay, then the
1930.
last one. 1937.
Confirm.
So this one is 1370. Perfect. Any question? Okay. So now we have our cost of sales. We just have to put the cost of sales there. 19. 6, 5, 7. And the cost of sales is supposed to be subtracted from the revenue. The cost of sales is supposed to be subtracted from the revenue. Any question? Any question?
20.
So when you subtract, you are getting 11, 250. And that one will be what? No. Okay.
It's 10 to 50.
Okay.
That can be
10. Any question, please? 10, 3. You get your question. Then you go to where? Distribution according to the format. Distribution cost. Distribution cost is also given
137.
37. We also have administration. Administrative expenses, right? And that one is also there. 1970. No, 1930. So that is the 2. You subtract the 2 from the gross profit to get profit from actually 70, 50. Pardon? Any question? Any question? Just in our way of working. At first, we are not doing the work. Then, if there's any other income, but throughout the question, there has not been any other income. So we jump that one. You go to where? Finance cost. And how much was the finance cost? Finance cost. The finance cost name is not there, but there's a finance cost. Interest payable. So you don't write interest payable here. You write finance cost. The right finance cost. That's how much? Okay. 350. Then after taking the finance cost out of it, you have what? Profit before tax. How much?
600.
30.
600.
600. So I normally say that for accountant you have to have some tricks. Sometimes you want to do things fast or what? You have to also take your time, even though you have to be fast. And you have to obey the laws. Because actually the account you don't do it. Because we are saying that bring distribution first before administration. All of them are subtracted. If you interchange it, it's wrong. What is your goal? It's wrong. They are all subtracted, but it is wrong. Yeah, this one must come first and this one will follow. They are all subtracted, but don't change it. If you change it, it's wrong. Okay. And you are saying that finance cost is the same figure as interest payout. But when you come here for publication, make it finance cost. If you don't understand, stop it. Okay, so profit before tax. Profit before tax. Then you have the tax. We started with the tax up there. There has not been any deferred tax, so it means that it's 2,500. So the tax is supposed to be 2,500. So income tax for the period is supposed to be 2,500. Any question? Therefore, then you take it out and it will be profit for the year. How much will it be? 4,200. That will be profit for the year. Any question? Profit for the year. Okay. So the question is saying statement of profit or loss for the year. So we don't continue. If it is comprehensive, then that will bring in other comprehensive income. And the revaluation surplus will be there. So the question is supposed to end here. But if you want to add, that is not part of the question. What I'm adding is not part of the question. Other comprehensive income. Then we went revaluation gains, which is 5,000. And there's no tax in the revaluation gain. So we are adding that to that, and it will be 9,200. And that one will give us total comprehensive. I said, we will be getting to do my 2 weeks now. Where is it? And then I go for identity. I told you that this is not part of it. But if you are told that the heading is supposed to be profit and loss and other comprehensive income or total comprehensive income, then that is the profit and loss. You do the comprehensive income in addition. So anytime there is a revaluation surplus or gain in it, then when you do it here, it must come to other comprehensive income heading. But the question did not require us to do that. So this one is not part of it. Yes, that I have put it there. I'm inside it will be an account.
Because when they're supposed to make that the revaluation surplus.
No, it will come to changes in it. It will come to change. Any question? Okay. So we have to be faster. Watching more. Okay.
So I take it. It actually says another comprehensive income. Read the difference.
Yes, yes. Just the difference. So you bring this one in and add it and get it to that. That's it. Okay, so let's do the B part, which is the. This is what?
This is
Statement of requirements. Statement of financial position. Okay. So statements of financial position as at 31st May 2020. As at 31st May 2020. Statement of financial position as at 31st May 2020. As for there, you can have 2 columns. That is okay. So we said that we start with what? Assets. We come to non-current assets. The heading, we got it one with both, but that is it. We have what? PPE, property, plant, and equipment. And how much is it? 39,600. 39,600. Have you seen it? 39,600. The one that we did. And it is okay. 39,600 here. The final figure there. There's no other non-current asset. So you move on to what? Current asset. Current assets. So with the current assets, we have to go and look for inventory. How much is the inventory in the person? Pardon? So inventory. Sometimes you bring your format, but please you have to check whether it's inventory in. It's not like you write it and it's not in. You put dash like. That's all the solution now. So if you read that there's no receivables, and you don't complete receivables there, I mean, how? How do you know about it now? Madam. There's no other non-current assets, so we bring the current assets. Okay, so inventory is how much? 40,600. Okay. Now I can push it to the first column. And you have trade and other receivables?
Yes.
Trade and other receivables. Trade and other receivables. Okay. So how much is the trade and other receivables in the question? You have 7,400. And the additional information. There was also prepayment. Okay. So we said that you cannot separate them. For publication, you don't separate them. So the heading is supposed to be trade and other receivables. So if there is prepayment separated, add it to the trade and other receivables. Sorry, add it to the trade receivables and call it trade and other receivables. So we are going to add them. Some of the why account and I will understand that. And you won't separate it, but I know the separate it. And you also separate it in the eyes of own yet. When you're near two. Okay. So you put it somewhere or anywhere. Trade and other receivables. Okay. Receivables. What's the other? Then prepayment. 7,600. We come here and it is 7,600. If you want to be putting the notes in there, it's also okay. So the tax here, you can say note 1. And you name it note 1. Please.
This one, would it be wrong when you do the actions right there in
Here, we don't want your details. For publication, nobody wants your details. So you don't have to be talking in it. You can do it. Go and do it somewhere and bring it.
So, sir, the notes that you are supposed to put there.
That is what I'm saying, that for tax note 1. So you can also say PP note 2. Yes, that one is allowed. So that the users will understand where the note is. You understand, but coming to work in there is not allowed. Don't come and show you any details here. Then, what again? The revenue is in there, this one. If it is the third one, here, allocation, you can see note 3. This one is also note 3. This one is also note 3. So we can put it in there. Finance cost, there's no note. So at gains, you can also refer it to note 2 because it's here. So you can be doing that. So trade another receivable, if it is note 4, you come and put it there. So you come and put note 4 there. Okay. The next item there.
Cash and cash.
Cash advance. Only cash advance. Okay, so you said that you will not write cash advance. What do you have to write? Cash and cash equivalent. For publication, if it is your home account, fine. But for publication, cash and cash equivalent. How much? So it's the same figure, but name it different. Like maybe information dissemination manager. But you go and it is a messenger. Your work is to is to send you to go and deliver letters in the office. But instead of saying a messenger, information dissemination manager. We don't want you to pay the person small. Okay. So we are done with the current assets there. Then you add them together. So add them. How much? 12. And you add it to the non-current to give us the total asset. How much? 52,500. Okay. So 52,500. Then you come to the other heading, and you say that the heading is supposed to be. Between the Babao and liability. You can even be putting the heading there. I mean, you are doing it. Equity and liabilities. We need to show about the Then you are supposed to be learning about capital and reserves. Capital and reserves. Even though the heading is equity and liability, the next heading is not equity, it's capital and reserves. Okay, so with the capital and reserves, then we come and do the changes in equity. That is also question number C. C says that we are supposed to do statement of changes in equity. Statement of changes in equity for the year. That one is also for the year. For the year ended 31st March, May 2020. And as I said, this account, the heading will come with the columns will come with the question. The column will come with the question. So let's go back to the question and check the headings of the equity and the reserves. So the capital and reserves in the question.
Share capital.
We have equity share, eventual, and I need the new number. Is this share capital or equity share?
Share capital.
Okay. So share capital. Okay. Then what again?
Revaluation reserve.
Okay. Revaluation. Reserves. Return earnings. That's all. You bring the two tasks. So the question will come with its headings. You just have to pick that one. Check out the revaluation reserve. Accumulated profit is the return. Any question with that? Okay, then you bring the opening balances. So when you get there, it's better you come and do this one and send the figures. Or you can jump that portion, go and do the liabilities. But normally this is a requirement. So you have to do it and send the figure. So if you think that this is not a requirement, then you can write some of the equities which you don't need calculation. Write it there because it's already there in the question. Leave a space, write it there, get that source, and leave. That's a stop work here, the around the whole time. Just have one moment. You have to be serious. I mean, sometimes you don't like stop work, then you just stop. Wait for them to come to get because that's too much is also necessary. Okay. So let's do that. It changes the opening balance, the balance at the beginning. Balance brought forward for each of them. The stated capital, the share capital, how much is there? 21,000. Revaluation reserve. In the statement, was it 5,000? I guess that was for the year. At the beginning, there was nothing. Then, okay, so no more prepare accounts. The accounts has been prepared, but not in line with the standard. But you do not have any beginning figure. You don't need beginning figure. You get it? The shares was issued from previous year. The revaluation surplus, the 5,000 that you saw there is the 5,000 which is here for the year. That is an addition. Right? So at the beginning, there was no revaluation surplus. That's why I'm putting the dash there. You get it? So you can see 0 or dash. Then the retained earning. The retained earning to how much is there?
14,000.
14,000. That is also some calculation that you have to do. Because that is the closing figure for that period. So when you check the income that they did, the income for profit for the year, check it. Go up there small. They were saying 6,500, and they also have some retained earning there. You see that the heading says that statement of financial position as at 31st May 2020. The that means that they have prepared it and it is not in line with the standard. We have to prepare it in line with the standard. So we cannot take their 14,000 as the opening here, because that is even a closing. The 14,000 is even a closing. If you can see the heading and the down figures there. So we have to adjust the profit elements there before we can move on. So let's do that. It's here. Retain and or accumulated. What the name that I give it is accumulated profits there. So let's do the small calculation there. So per the question, we are having the question because we have to get the opening balance. The one that I have given at 40 is the closing balance. So the question that is the closing. Is the closing, and that is 14,000. Which you have to follow. But the question, the 14 is the closing balance. Is the closing balance. And before you want to get the opening, add the profit for the year, subtract the dividend, and get the closing. That is what you want to do. Because the statement for the year will start from the beginning to the end. So you cannot bring the 14 here because the 14 is the end. Okay. So you have to adjust and get the opening balance. Okay. So the closing is the 14. Then let's go and look at the current year. The current year adjustments that we have to do. The current year, the profit for the year is how much? Which is also the figure at the end. But you have the profit, not our profit, the profit that you got. There was 6,500. That 6,500 is also, they have also deducted the dividend, which they supposed not to deduct. You saw that? Okay. And from the, let me check it. So the difference is how much? 200, right? It's 200. And there was also under provision of 400. Do you see it? This under provision too. You're supposed to have also done it, so we are still going to read it. Okay. So let's move on. So the 14,000 is supposed to be adjusted with the current year. So we have to take away the tax element, which is under provision. So let me bring another column. 400. That's 2,000. The estimate of the current tax is 2,100. Current tax provision. Because before you get the profit, you have to take away the tax out of it. And there was under provision of tax, and the current tax is also 2,100. Before they got this one, the closing, they had taken care of the tax before you get the closing profit. Like from here, as we did, the profit for the year will be after the tax deduction. So their profit for the year, which they are saying 14, means that they are supposed to have taken care of this one which they did not. So we have to take care of it. Which is 2,100. And it will be how much? 3,000 and the same 2,500. So the difference will be 7,500. And it says that the revaluation surplus, that was transferred. There was a revaluation surplus that was transferred. Read that portion for us. Check it and read that portion.
There was a revaluation of land and buildings during the year, creating the revaluation reserve of 5 million. The effect on negotiation has been to increase the building charge by 300,000.
Okay.
Credit Trading Limited adopts the policy of transferring the revaluation surplus included in equity to retained earnings as it is realized.
Okay. The figure was not given. There was a 300. No, apart from the 5,000. The transfer of the figure. Okay, let me check it. But there was a transfer taken care of. And how much is it? 300,000. Okay. So that is what it means. The depreciation. Okay, read that section again so that we use that one.
The effect on depreciation has been to increase the building charge by 300,000.
Is to increase the building charge by. Okay. So normally, if there is going to be a transfer from the income surplus, that is the other comprehensive income, which is as a result of the revaluation gain. The brain behind this is that if there is other comprehensive income, that figure, or if there is a revaluation surplus, the income will increase, or the revenue in the revaluation gain will increase the PP, the value of the PP, because it was maybe like the primary amount, or the cost is let's say 5,000, and there is a revaluation gain of let's say 1,000. So the total is going to be 6,000. And this is what you are going to base on it to calculate your depreciation. True? True? I say that if you have the cost of an asset and there's a revaluation, the new value is what you are going to use to calculate your depreciation. That is true. Okay. That is why the standard is saying that the management have the liberty to reclassify some of the revaluation gain from the other comprehensive income to the income statement. Because if you are using this one now, the depreciation will increase. If the depreciation increases, it means that your profit will go down. True. Your profit will go down. So in order to compensate for the increase in depreciation, then there is going to be a transfer of the revaluation surplus to income statement. And that transfer will cater for the increase in depreciation. So that is what the sentence there is explaining. So anytime that the person says that they want to make a transfer to cater for depreciation, it means that they are reclassifying the gains to the income statement, because the other comprehensive income, as we did first, is separated from the income statement. It's separated from the profit and loss. So if you bring the gains as 5,000 down there, it will not cater for this one. Meanwhile, we have already calculated depreciation in this one. So in order to compensate for that, you come and add a certain portion to the profit for the year as the reclassification or transfer from other comprehensive income. So that one will have come before the finance cost. It will have come before the finance cost. But we have to do the calculation here. You know that for us to know the opening balance, that's supposed to be here. But still, we are going to also bring that 30 later on. But all that we are saying is that 300 will be an additional income in the return end, kind of.
We agree that instead of evaluations, now
Finally, you will transfer the 200 from that, maybe to be 4,700.
then the 300.
Yeah, 300 will go to the return end. So when we come here later on to do, you see that it will be here again. But the adjustment also means that you have to add it to there. Because they have already done this. All the things that they did not do, we have to do it again. That's why you are going through almost the same process again. So as you have this as a person, then you have to take the tax out. Because from the top they did not take the tax. Was there any tax in the income statement? No. So they did not take the tax. And they did not also do the reclassification in there. So you have to also do the reclassification. I hope it's okay. Alright. So the reclassification or the transfer must happen. And the transfer is how much? 300. Because there are 3 zeros at the top. The transfer is 300. I'm saying that anytime that we can say reclassification or transfer for revaluation reserves. I'm saying that when we were doing PP, we said that you can use the cost model, revaluation model, right? So if you are using the revaluation model, the carrying amount of the assets, if it is 10,000 and the assets is revalued to let's say 12,000, it means that there is a revaluation surplus of how much? 2,000, right? And when you are going to calculate depreciation, you are going to base on the revalued amount to do the calculation of the depreciation. So if the useful life remaining is still less than 6 years, it means that the depreciation here is going to be 12 divided by, which is going to be 2,000. Okay, 2,000. It's going to be 2,000 for each year, right? If it was 10,000 and the remaining useful life was less than 7 or 6, the depreciation wouldn't have been 2,000. It would have been lower. You get it? So far as the depreciation has increased to 2,000, then the standard is saying that management have the option, this 2,000, they have the option to classify some of them to cater for the depreciation. How do they do that classification? The standard says that you have 2 different methods. It's either you calculate the depreciation before the revaluation. So depreciation before the revaluation, let's say 6. When you divide that one, how much will it be?
1667.
1667. Then you compare it with depreciation after the revaluation. Right? The difference. So the difference is let's say 3, right? Then each year you have to transfer this one from the revaluation surplus to income statement or the retained end. Is that okay? If you don't want that one, you can also kind of depreciate this one over the remaining useful life. And that one supposed to have given us the same, just like we use some other figures. It's supposed to give us supposed to give us the same answer. So we will classify this one into the income statement. So if you come to the retained earnings, that means that you have to add that one as an additional income. Do you get it? So after you have taken the tax, or fine, you would have added this one before taking the tax. It doesn't change anything. So this one is an additional gain, which the original person did not cater for it. So you are adding it. So the amount supposed to have been how much? When you add it, 11,000. Let me push it small up. So here is going to be 400, 2,100, 2,500. So it was 11,500, and we are adding the revaluation transfer, revaluation surplus of 300. So you are getting 11,800. So that's supposed to be the beginning figure. Right there, and consumption will be there. Surplus. Right there, consumption, you cannot just do anything. So all those ones that you were doing was nice, and you are getting it. But when you get here, I mean, you're supposed to do something like that. You are adding, you are not subtracting. You are not subtracting. Any question with that? See, and go ahead and answer. Okay. So that's supposed to be? Yes, please. You said? Yes, yes. It wasn't created for you. That's right. Yes, the closing figure for that. So we are going to work it back again. So that's supposed to have been your closing figure. Alright, this is the profit the person that they said is the closing figure. So you do not take care of this. So you have taken care for them. They do not take care of this. So they are supposed to have given this one as a closing figure under the retained earning. But they said that it's 14,000. So that's supposed to be the closing figure for them. So now that you are going to work it back to get the opening figure. Okay. So let's assume that there is no opening figure, but you are still going to get it. Then profit for the period. For our profit for the period. How much did you get? That is the profit for the period that you have. I'm stopping this one for now. So profit for the period. That is profit for the year. Profit for the year. Profit for the year is what you have gotten here. We did it for publication. You are supposed to get a profit of 4,200. 4,200. Any question with that? As for that one, transfer to get no problem. Then there is also revaluation gain or revaluation surplus. Revaluation surplus or gain, and then we transfer rate for revaluation gain. The revaluation gain will go to the reserves. How much will it be? 5 million. It was 5 million. Oh, and the reserves at the top. So that is the revaluation gain. You can still be adding the total, but for the opening weight, 5,000 also. Okay, then there is a dividend. Dividend for the period. That is dividend. Interim dividend. At the top there, how much is the dividend? So normally the dividend will be taken care in each of them. Is it under the share capital revaluation reserve or retain? It's under the retain. You have to know where to put it. It's a profit that they gain that they are paying the dividend. In the dividend is a subtraction. It's a subtraction. 200, right? 200. So here it is minus 200. Okay. Then we come to the transfer. The transfer. Transfer from or we can say reclassification. Reclassification in here. So the reclassification means that we are taking 300 out of here and we are adding 300 to this side. We are taking 300 here and adding it here. What I wanted to explain here, you just enter it like that. But they did not take care of it in this. So that's why we wanted to adjust to get the closing figure. Okay. Any question up to this side? Okay, so it means that you can get the closing. After this, you can get the closing. This one is still 2,100. Sorry, 21,000. This one is 4,700. Then the return earn has been given here. The return earning is 11,800. Then we find out and get the booking. So when you have the 4,200, you subtract the 200 from it and add this. Then the difference is supposed to be the booking. The difference is supposed to be the booking. 7,000. So the booking is supposed to be there. So here we are. 7,500. So this one was not given in the question. If it is a trial balance, it may be given. If it is a trial balance question, this one will be given. But if they have done the statement, it will not be given. You have to get it. So they gave us the return earning as 14,000. But the 14,000, they have not deducted the income tax from it. Because when you look at it, the 14,000 up there is the same thing that they sent there. So they have not deducted the tax from it. So you have to take care of the tax. And the tax was 2,500. So it means that you have to take it out. And they have not also taken care of the transfer. So you have to also add the transfer to it to make it 11,800. So the closing is supposed to be 11,800. But we got a profit of 4,200. And we pay a dividend of 200. So it will be left with 4,000. There was a reclassification of 300, so 4,300. But the closing is supposed to be 11,000. So this difference was gotten as we build up the whole system. Any question on that? Any question? So that means that you can get the figure here. Now 28,500. Then you can add to get the figure. 31,800. 35. 36 what?
39,600.
Okay.
Wait, 37,500.
37,500. Yeah, the exams average over points. So this is a requirement actually. So we are supposed to show it. Before we will fine, but we would have still done the other one without using this one. So when you come here, you do the copy back. You come and do the share capital. The share capital is how much? 21,000. The revaluation rate is the Twitter 4,700. Then retain and 7,800. So it's just a copy back. If you are able to do this, you just copy the balances out there. Any question? So you add them together to get the total equity. 37,500 is in here. Then we go to the liabilities, the non-current liabilities. Non-current liabilities. What are the items under the non-current liabilities? public having items there. 8% for non-current liabilities. 8%. Debenture. 8% debenture, how much? 7,000. So the 2020 something is the maturity period. It's not necessary. 5,000. Montana year, is it? 5. Okay. 5,200. That is the only thing under the non-current. Then we go to the current. Current liabilities. Current liabilities. What are there? Pardon? Okay. So normally if there's nothing there, we can say trade and other payouts. Or you can make it one line item, it doesn't change it. You can say current liability and put it there. So far as there's no details in it. But anytime it's only one, it means that it's trade payout, that is there. Do you get it? So you can put current liability in the figure item. Let me do it that way. So no cause any confusion. So current liability is how much is it? 7,800. 3,000. Okay, so we add it to the non-current, and we are having how much? 12,500. With the 12,500 plus the equity. 50,000. This one is 50,200. Oh, okay. The tax supposed to come. The tax for the normally it's only this one that comes. The other provision will not come. The 3,100 supposed to come. How much is it? And it is under provision. So the tax provision, it has not been paid. It has not been paid. And if it has not been paid, it means that it's a liability. And that we have to provide more. When it is under provision, that means that we have to provide more, and that one has also not been paid. But if it is over provision, it means that it has been paid in previous year. So that one, we are not going to bring that one. But since it is under provision, that means that we are doing more provision, which will be paid later on. So you are going to pay all the 2,500. But if it is over provision, it means that it has been paid earlier on. I hope it's okay. All right. So let me then make it current liability and make it trade payable, which is 7,000. 7,200. Then the tax. The income tax. The income tax 2,500. So that's when you add to the tax. So how much would it be when you add all? Add it. 15,000 how much? 15,000. Then we add it to this one, 52,500. So that's 100. So this one is passed on with the heading. Total equity and liabilities. Total equity and liabilities. Total equity and liabilities. Yes, ma'am. Yes.
You know, the same as this current asset. Actually, we have taken based on the question, the current liability comes first.
No, according to the publication, the current liability will come first. Non-current liability will come first before the current liability.
But this question, it was line item that current liability is 7,900.
Yes. So that is the current liability. And under the current liabilities, we have separate items that makes the current liabilities. When we are doing the format, under the current liability, we have the trade payables, other payables. We can even have income tax also there. Income tax that has not been paid is also under the current liability. But here the question gives us only one item as current liability, right? And I said that at default, if there is a current liability figure there, it means that it's trade payables. Any current liability, when there is no discretion, it means that it's trade payable. When there is a current asset, as for the current asset, there are many, so it will be given to you. But for current liability, if it is only one item, that means that it's trade payables. But since we are going to add the other component of current liability, that's why I separated the heading from the item as in trade payables. You get it? Because if I write current liability and I also write here current liability, it doesn't make sense. The head is supposed to be current liability, and under it we have the items. The head is supposed to be non-current liability, under it we have the items. So if you give me one item, fine. If there is no other item, then I can say that it's current liability. But the tax is supposed to be a separate line item apart from the current liability. The non-current can next.
Based on the question that we saw.
No, the question is not for publication. Your format, which of them come first? The question is not for publication. But you have done accounting and they are saying that for publication. So how do you arrange it? It's a liability, but according to the standard, the non supposed to come first, then the current down. When you add, you are going to get the same thing, but you have reclassified it. That is wrong. It's inappropriate. That means that the mama Any question? Any question? So the questions will just be, if it is a trial balance, fine, we look for revenue. If the additional information says anything about revenue, go and adjust the revenue figure. Come and put it there. It's not there that you're going to do the calculation. You have to get a cost of sales. Sometimes in the trial balance, the cost of sales will be given. If it is not given, like we have done, the calculation that we did, go and put all the components on cost of sales and come and put it there. Subtract it to get the gross profit. Then we find out the distribution cost. And you have told you what makes the distribution cost. All the costs that you get in order to get the product closer to the customer. To the distribution itself. And if there is any cost that receives that send it to distribution, you don't have any question to question the question. Now, so you put it there under the distribution. You put the figure there. Administration 2, you put it there. You subtract the 2 to get the profit from operation. If there is any other income, because some question will come with the income, then you come and add it. You get profit before the finance cost or before the interest. You can bring the other income in addition at the same point with the first finance cost. So if it is like this, I can put other income here, and the figure will be here as a positive figure. Let's say 100. Then I will put the finance cost there. It's also if you also want to add before subtracting the finance cost, it's also an option. Then you take it off, you get a profit before tax. You calculate the tax element, then you get the profit after tax or profit for the year. If there is other comprehensive income, you add it, then you are done. You go and do the financial position and it must follow that form. Asset, non-current asset, current asset, total asset, then the equity and the liability, capital and reserves. You put the headings there. Put the headings there and be okay. Because the question, you see share capital and all those kind of things. Come and write them. Even if there is no figure there, write them first. So you go and do the calculation, come and fix the figures in. And it is better than, it's like you don't know what. I would have to read the question before you start. So you cannot tell us that if there is no administrative cost, change now the administrative cost.
So what was zero?
I choose zero, that's it. I just want the hotel pretty good. So it's not that difficult. So please, you practice it. The format is what is important actually. For the items and the, what do you call it, the treatment, is the standard that you have learned. That's how you are treating. So what the standard says is what you are supposed to do. All the items. So if you know a little of the standards, you know how to deal with this one. And some of the figures, as we said, doesn't come with any calculation. This one, there was no calculation. Cash and cash equivalent, no calculation. A lot of them, there is no calculation. So you cannot tell us that you get zero. A lot of items, no calculation. Put them there. So if revenue, no calculation. This one, that there is calculation. The finance cost, no calculation. The name you have, which now here, you want to have a problem. When you get to the exams, just be serious in the exams and get things done. Other than that, it's like it's difficult. You write and you don't get it. And something. Any question? Any question? I guess we have to break for a while. How many minutes? 30 minutes. We come back at 3:30 and come and do the cash flow. So 30 minutes for the cash flow, please.
Good.